Good morning, everyone, and welcome to day two. It's amazing how day two always seems to start a little bit slower than day one. I'm sure it has nothing to do with people going out last night after the event. So obviously, welcome everyone to today's session. So really, I'll go through part of the thesis for the whole conference, right? And I'll give you an idea as to how we think about things from an investment perspective and also the opportunities for companies, for investors, etc. So when we were thinking about the thesis for this event for this year, we knew that the great transformation was a core part, and that obviously focused on the innovation aspect. But we realized that with our ecosystem, you pretty much have, on the investor side, you have two different headspaces. There's one, obviously the love of innovation, the love of discovering innovation and investing into exciting growth opportunities. The second part is also the desire for other parts of your portfolio as it relates to backing different fund managers and also investing into yield opportunities, and then also the Australian love of property and also innovation in property as well. So if you look at the themes across the actual 2 days, the first day was obviously around the core themes of obviously innovation, climate tech, fintech, Web3, etc., because we see those as core themes of interest for our investor base. Today's focus really turns attention on obviously venture funds managers. We've got some incredible presentations today. Obviously we've got a Startup Bootcamp with Jackie, Peter Mobbs from 5 Sigma, which if you get any time to spend with Peter, I said it's incredibly valuable. Going from his journey as an owner-operator through to an angel and now through to actually building his own fund and the kind of track record and success he's been able to do that. Same with Yash, he's focused on AI. He's been talking to me about AI for months before it became red hot. And when you hear some of his own personal angel stories and then now what he's doing with the fund, it's exciting to see this. And then also likewise with the guys at Reach, I said, it was actually one of our subscribers that said it to me best. He says, what I love about the software and the platform is that we just put basically a whole range of different alternative fund managers in front of you that give the opportunity to have a look at. And I suppose the two biggest themes that we've noticed over the last couple of years, and I said this yesterday in this sort of opening present, by the way, I just realized I don't have a clicker. So if I can get a clicker, that'd be great. We talked about how the desire for yield and also obviously climate tech were some of the key areas. There we go. Oh, there we go. And so obviously that's going to be represented in today's presentation. So I'll go through my introduction slides, but I just wanted to give that as a bit of a thesis. Now, also today we're going to be joined by a lot of exciting ASX listed companies, and this is what I'm super proud about is we're actually also going to be streaming that to the stake audience, which I'll mention in a second. But we've been very, very fortunate to work with some great ASX listed companies very early. Our thesis for doing a deep dive into the small cap listed space this year is that we know how much their share prices were impacted last year. Regardless of how the business actually performed, all their share prices were hammered in the innovation part. So one of the key things, we'll be talking about that also in our upcoming investment trends panel session as well. So today, as I mentioned, is in partnership with Stake. Stake's an incredible online trading platform that you probably would have rose to people's attentions over the last few years when they got backed by Tiger Global. But as I said, they've built their business now to have over 550,000 account holders, which is absolutely incredible in such a short space of time. So we're proud to be not only working with them, but also creating visibility for the small caps that we're going to be featuring on the today onto their actual website. So as mentioned yesterday, I'll go through some of the parts. We talked about the acceleration of transformation, what GFC did. And then likewise, we talked about how COVID had a role in that as well. This also happened in the listed space as well. And it also happened in different funds in which they're going to be attracting. So as mentioned in this, as far as these are the core thematics that we are focused on. Now today, what you're going to see a lot of is actually more in that sort of personalized healthcare in the life science space. So we're very fortunate to work with some very exciting life science companies. As yesterday, like we mentioned about Recce, Dimerix, Radiopharm, Chimeric, and also the one that sort of became personal to me over the last sort of couple months is EBR Systems Inc., who are developing basically a pacemaker which has no wires. And that became personal to me because of basically my son we found he had quite a complicated heart issue. And so you realize that this space is also quite personal in that people also do back life science companies which relate to illnesses which come across with family members. And that's been very, very common in this space for a long time. And also what we know is with these companies, whilst they do take capital to actually get to this stage, and whilst they do take time to get to it, there comes this curve when, from an adoption perspective, where investors really start to see the gains and the take-up and I suppose the acceleration of take-up in the companies in which they're backing. And this is why we always like to refer back to the adoption curves, because whilst it does take time, so when they do take place, it's incredible to see the transformation. And I'll give you a perfect example. One of the companies that we work with back in 2017, 2018 was a company, little known company called Imugene at that time. And I remember they did a presentation at one of our events and their share price was 0.007 cents. And I was like, I remember an investor come up the back to me and said, I've actually just put in a buy for that because I'm pretty sure that can't get lower unless it goes out of business, right? And that was pretty much the Australian mindset, right? It's like, let's have a punt, right? And then you see that company to go to 2021, that hype when it went up to, over $2 billion market cap, and we started working with them at a $30 million market cap. And to me, that what becomes exciting about some of the ASX listed companies is that when markets do go through that sort of cycle of that bullish cycle, right now it's obviously been a bear cycle for the last sort of 12 to sort of 15 months. Really, you start to see, almost returns with small caps as what you were previously trying to look for in private companies, where you can get that sort of 5x to 10x in the small cap market. And that's the volatility that goes with the innovation space, but also that's the downside and also the upside opportunity. So I won't go through these slides because I saw them. Okay, so today we've got some fantastic speakers across a bunch of different areas. So we're very happy to have Amit from the ASX to come and talk about some of their initiatives and what they're focused on from the year ahead. I've known Amit for a long time. And, to me, I love that they get involved in activities like this to create sort of more visibility for the early stage companies. Friska, I've invited a good friend of mine. You may have seen her content online. She recently did a TEDx talk, which was quite, circulated quite strongly. And basically everything she's focused on around is innovation amongst sort of inside corporates and what that process is and what that looks like and what the upside potential that comes along that with. So I know everyone will enjoy her presentation. And then also Toby Norton-Smith, from X15. The Commonwealth Bank has invested a lot in the innovation arm, which is the actual X15 arm. And he's going to be doing a presentation on some of the initiatives of what they're focused on and how they're taking an approach to innovation and what they're expecting from their side and how they can utilize basically innovation and then correlate that across some of the bank's assets and distribution networks to create and to roll out amongst their customers. So they'll be on stage 2 straight after I finish my actual presentation. And then Peter Mobbs, as I said, I can't talk about Peter highly enough. Every investor needs to have a listen to his presentation. I said, before I started speaking to him, I didn't really think about the ed tech space too much because it sort of hasn't been on my radar. After listening to him, I said it really grabs your attention about what comes next in the innovation space. So that's going to be the keynote speakers for today. Different panel sessions, obviously the small cap investment trends, got some incredible guys coming along. Obviously Niv, you guys may know pretty well. We've worked with Niv for a number of years. Also Rajiv from Alien Capital is also coming along as well. And I'll be the moderator for that session. So super excited to be hosting that. And then obviously some of the corporate finance and M&A trends that it's expected to come for the year ahead. From the presentation, so that's in presentation room 1, which is this room. Presentation room 2, across the other side, will be alternative fund investment opportunities. As I said, we're very well aware that that's been a focus for investors, whether it be the desire to back, either fund managers or the desire to access yield opportunities, etc. But that's been a prominent theme in our ecosystem for the last sort of 12 months. So that's going to be across the different panel sessions. For the founders that are joining today, we've got a masterclass at 9 a.m. with Sales Director Central, which is taking place now. Then We Connect, then Cashcade at 10 a.m. and then syndicated investment opportunities at 11 a.m. With Andrew Ireland. So we've got a big day lined up. We will be finishing early. We'll be finishing probably about sort of 3 p.m. And as I said, it's funny how hard, I said this in a joke yesterday, it's funny how hard we have to work to bring people, to the event and make sure people show up. What's always amazing is how at 3 and 4 p.m. when we start to host the drink session, how easy it is to get people to turn up. It's always a funny dance when you do it. But what makes this thing beautiful from when we actually run it, and I'll go through the sponsor in a second, is that typically what we find is that the formalities of the 2 days is really nice. Everyone's connecting. There's a great buzz and energy. It's incredible the deal making that gets done when the drinks come out. A big thank you to our partners, Stake. I gave a lot of talk yesterday for the likes of WeConnect, Audicon, who I think are incredible in what they actually do. Flav, I'm sure you guys have all been, I'm sure everyone was surprised about how delicious the food was from Flav yesterday. For me, I just took my family there on the weekend. We absolutely loved it. Pacific Channel said Stephane's here. I said incredible guys. The one I want to mention today is just Stake. I said, cannot thank them enough for the support of this event and how they've invited their ecosystem of investors and traders to actually watch this. As I said, sometimes it's incredibly hard for small caps to get visibility. So when you have a platform that's so willing to actually create that visibility for small, early stage ASX listed companies, that's a big win for those companies. So big thank you to Stake for the event. Obviously, I recommend to check them out as well. So they basically said they've done a great job in simplifying the trading aspect and making it quite cheap. And so obviously, Sales Direct Essentials, Sheffen in catering the VIP room. I said, I know two different things, two different styles of food. Said that's what I love about doing it. But they said for years they've been catering our VIP room, and we always get incredible feedback from people about how much they love the food, how much they love what those guys do. And likewise with all things with WI, I said guys like Sheffen are available to invest in. Flav is available to invest in. So I'll just clarify, Stake is not raising money. They had some big backing you probably would have seen in the media last year, just to be clear. I think they received about 90 million and had Tiger Global leading it. And then obviously, as I mentioned about Pacific Channel and then Sales Direct Essential. So we cannot thank these guys enough for their support of the event. And the reality is without the companies that get featured today, without the sponsors, none of this takes place. So a big thank you to them. So the thing I asked for this, and just my final slide, actually, it's not my final slide. One thing I really always ask is that what's beautiful about the WI ecosystem is that one person always has 10 to 15 people in their network that are relevant to the companies. I invite you to either bring them along today, or I invite you to introduce them to a company which you think may be relevant for them. So, I said, even if an opportunity is not relevant for you, it's always asking yourself the question, is this opportunity relevant for someone in your actual network? From our perspective, we've put the entire conference on the Crisp software, which I'm sure you guys would have accessed over the last couple of days or been messaging back and forth. Simply just log into app.crisp.io. Basically, the way we've thought about this is everything we want to do is just to simplify the engagement between investors and companies. We want to streamline it, we want to standardize it, and we want to make it so that everything becomes almost uniform in such a way that people get access to what they want instantaneously. And whether it be the frequently asked questions, whether it be the documents related to the companies, whether it be the news and milestones that they've achieved, all that is just designed to be simplified so you don't need to ask for it. And then same with the matchmaking. I want you as an investor to see the most relevant deals for you. Post the event, just so you know, what we'll be doing is we'll be actually automating emails which actually go out from the Crisp platform. So 3 times a week you'll see emails, and effectively they'll be relevant to you. So as I said, we've worked really hard over the last couple months to basically get it to a point where we actually stop curating emails. We'll pretty much only look to send out our weekend newsletter and then obviously the dedicated features that we do on companies. Outside of that, it will actually be driven directly from the Crisp platform. And the idea is just, we want to focus on that topic of relevance. We know that people want to look at deals that are relevant for them. And that's the only way we could do that is through a platform approach. So the 3 principles have been, how can we build software which lets the ecosystem do what it naturally does? Said the more time you spend on the platform, you more you can appreciate all the sort of UI, UX design thinking that's gone into it. The second one is build a scalable. So if you go into the actually investor networking room, you'll see there's not only investors from Australia, you'll see there's actually investors from ASEAN, you'll see there's investors from Canada, and also you'll see there's a lot of investors from the UK as well. because we've effectively brought the entire ecosystem together inside that actual platform, because that's really said everything about what we're doing is just creating a global opportunity and removing friction from the actual process. I won't mention too much about that because you've experienced it. As I said, my last point that I always like to highlight is this whole space is about one conversation and how it can change the entire trajectory of a business. And so everything we want to do is to facilitate that over and over again. If we can provide an introduction that's relevant for you, if we can actually connect you, if we can facilitate a conversation or facilitate a discussion, that's what we're aiming to do. So for everyone, I've got 15 seconds left. Thank you for joining day 2 of Emergence. I'm sure you're going to have a great day. As I said, we've got networking drinks that are from about 3:30 onwards, something like that. Toby Norton-Smith will be presenting on the second stage straight after I finish. And obviously, we've got the panel session coming up in this room as well. So thank you, everyone. Enjoy Emergence day 2.
Everyone. Oh, okay, that took me aback. So good morning, everyone, and welcome back to day 2 of Emergence. I'm Rhythm. I'm going to be your MC for the day. And yesterday, some of you were here, so we had an incredible lineup of sessions featuring some of the most inspiring thought leaders in the industry. And today we have even more in store for you. I hope you had an amazing time yesterday, and we're looking forward to kicking the day off for you. So our first keynote speaker of the day is a highly experienced leader who has worked across many different industries, including financial services, consulting, and technology. He's here to talk to us about why X15 Ventures is interested in entrepreneur-ready startups and how they're helping startups to scale their businesses. So without further ado, please join me in giving a warm welcome to Toby Norton-Smith, the Managing Director of X15 Ventures at Commonwealth Bank.
You want this on? Cool. Good morning, everyone. Thanks for the time to tell you a little bit about X15. Good morning also to everyone online today. I do actually want to start by acknowledging the traditional custodians of the land on which we're on today, the Gadigal people of the Eora Nation. I think, a particularly important time in the last 24 hours, to potentially permanently recognise that custodianship across the country. So I pay my respects. Look, conferences like this often are ones that I go to, often abound with topics that are sound a little bit like the one I want to talk about, the sort of magic merging of like startup and enterprise. How does that work? In the space that we work in, primarily fintech, the narrative is often sort of, fintech's moving from competing with banks to partnering with banks. So it is a well-worn topic, but I think there's a very good reason for that. And the reason is that it's difficult. It's incredibly hard to pull it off, to get that sort of magic where a startup can plug into a corporate successfully. McKinsey recently did a survey of portfolio companies inside CVCs, corporate venture capitals, and 28% of the portfolio companies were satisfied with their partnership with the corporate. And I'm sure to the extent that you will meet any sort of thoroughbred VCs at this conference or have a hallway conversation, they wouldn't be shy about telling you that, they'll often actively dissuade portfolio companies from getting distracted by the allure of corporate partnership, particularly too early. So it's sort of against that prevailing logic. I want to share a bit about X15 Ventures, our model for how we help plug startups into corporates. I'll provide some examples of ones that are working well, but I also want to share some of the things we've learned over our last 3 years, to help you think through whether enterprise partnership is a right pathway for, if you're a CEO or on the board or a leader of an earlier stage venture, if you're investing in businesses, just to give you a sense of some of the choices you should think about, including even if enterprise partnership isn't the pathway. Our view is that getting enterprise grade, is really important, increasingly important for startups to get ahead of that challenge. How are we going with the ClickUp? Let's have a look. There we go. We are X15. We're backed by CommBank with their sort of venture arm, and we call ourselves a venture scaler. That's a bit of a careful choice of words because, most clearly we're not actually a traditional CVC, corporate venture capital model. We don't have a closed-end GP LP structure. We're not primarily incentivized by sort of near-term ROI metrics. Our objective is to provide near-term benefit to ventures by helping them scale securely, which ultimately delivers long-term strategic benefit to CVA and its customers in the form of, exceptional new services that plug in to the CommBank experience and can be provided to customers at really low cost. Now, that promise, providing corporate leverage, is probably quite common to many CVCs. Where we've sought to distinguish ourselves a little bit is in, finding points of leverage that are repeatable and scalable. And of course, the most repeatable and scalable things come through technology. So, what we offer ventures is a venture platform, which sort of really provides three things. Firstly, a very, opinionated infrastructure and technology stack, which allows ventures to build quickly and safely. I think no one's counting, but I think our record for a regulated venture would be Kit, which is a kids' money app. So obviously financially regulated. We got that to market from sort of concept or just PowerPoint idea to market in 8 or 9 months. Second thing we offer is risk and security tooling and practices. We do that to ensure that at any time those ventures are effectively staying safe, and we do that so that they can take advantage of the third thing we offer, which is plugging ventures into CommBank, into the customer base, into the data sets, and that's a back and forward relationship. So look, we've still got a tremendous amount to learn in our own journey. We're 3 years old, but I did think it'd be helpful to share some of what we've learned and bring that to life with some examples. Look, when we think about a venture and its prospects for success, there's probably far more sophisticated frameworks than I'm presenting here today. But keeping it simple, we broadly think about 3 questions at different stages of a venture's growth for whether it's going to make it. The first and most obvious one is it meeting a customer need? Defined probably more commonly in sort of startup land as does it have product market fit? Notoriously hard to measure or to understand, sort of the famous Mark Andreessen quote, sort of, but you know it when you've got it. That's question number 1. Number 2, unit economics. Is it on a pathway to some really sort of compelling, effectively variable unit economics? And then finally, the last question, do we think it's scalable? And that's more than just what's the market size. It's also, do we think that they've got a business model that will endure through the cycle, through investment cycles, through consumer cycles? And I think that's particularly relevant right now. So look, on the first question of customer need and product market fit, a venture vehicle like ours, I actually don't view that as our primary value add to ventures. That's really down to founders. That's really down to, the incredible hustle and sort of ideation that can emerge from the startup market. Most of our ventures will track it. We use a measure called, the 40% measure or the Sean Ellis test. If anyone's interested in that, I can tell you about it afterwards. But what I would tell you is sort of learning number 1, if a venture that you're involved in hasn't yet found product market fit, don't start an enterprise conversation. You're not ready and you'll waste your time and your founder's time. So it's the next 2 metrics where I think enterprise partnership does have potential to add value to ventures when they're ready for that. Because we're on a property track, I thought I'd pick 2 examples from our portfolio that are property or home related. The first of those is Home-In. Home-In is a digital home concierge experience, which doesn't immediately sing as the most exciting thing. What it is in the background is a workflow solution that connects lenders, conveyancers, and customers in one app so that they can then take all the steps necessary to purchase a home. We've had tens of thousands of customers use it. It's approaching 4 billion in settlements on the platform. And really what it does is it saves lawyers time which results in sort of higher quality, lower cost conveyancing. It leads to lower risk that people miss their settlement date, which is one of those great stressful moments in life when you're moving home. It reduces the risk of deposit fraud, which is something that's on the rise. And ultimately it's a great experience for customer. The NPS for home in quite consistently has sort of sat in the 60s. So look, it's got product market fit. But so, the next question we ask, as per my framework, is does it have unit economics? And don't worry, I'm not going to take you through this slide. This is just illustrative. But when you think about unit economics, two of the obvious drivers, obviously what you can charge a customer, but you're thinking about, what's the cost to acquire a customer and what's the cost to serve a customer. Now, for Home-In, we think one of its advantages is it's got a very efficient cost to serve customers. And we think we've created some real value in the IP of that business. I bring that to life with the workflow that we've got up here. In New South Wales, there are 43 steps for a lender, a conveyancer, and a customer to effectively help you move into and secure title on a new property that you've purchased. We've automated or workflow managed 30, I should check my notes here, 34 of those. And that's through a combination of technology integrations through to PEXA, digital verification services, OCR, and yes, even a little bit of AI, which everyone has to be using these days. So that just leaves 9 steps for a lawyer to focus on where they add the most value. That reduces their effort by 70%. And it means we can deliver great service at a low cost. It removes all of the back and forward between customers, lenders, and conveyancers, which are frankly inefficient. So far, no value we can add there. That's the IP of the venture on their cost to serve. But the second dimension I mentioned of how you attract customers is your cost of acquisition. And that's where I think enterprise partnerships really helped Home-In in that cost to acquire customers. A little bit of a backstory. Home-In was, we built it before we formally launched X15 in February 2020. We then went live with Home-In as one of our first ventures that we'd actually built. This wasn't an investment or an acquisition. And the results in the first few quarters were pretty underwhelming. We found it really hard to acquire customers, at a reasonable cost through the traditional portals. Now, almost anyone in this room, if you're invested in or thinking about consumer-facing enterprises, one of the great challenges that all Australian businesses find, if you're targeting a digital customer audience, is there's only really 1 or 2 platforms, global technology, Californian-based platforms, by which you can reach those customers. And it's expensive, and you often find yourself bidding on the same keywords as your competitors. You often find yourself paying exactly $1 more than your nearest competitor is prepared to pay. Like, that is a very common theme across industries that have consumer-facing digital platforms. So what changed for Home-In is when we thought it was ready, we effectively plugged it into the CommBank app, our enterprise partnership. And since then, I think we've had 10 quarters of growth of about 44% quarterly growth, which is great. I'll bring that to life a little bit more because the detail behind that is what matters. Like, to pull that off, we've targeted customers inside the CommBank app effectively when they've been pre-approved for a mortgage. So customers walked into a branch, customers applied online for a mortgage. Next thing that gets offered to them is an introduction to Home-In, and they go through a sort of data and auth flow to confirm, and a permission flow to confirm that they're interested in looking at that service. The learning from this for you, if you're looking at enterprise partnership, is that you need to have really tight, what I'd call product channel fit, and the enterprise channel is a very narrow one. What I mean by that more specifically is, unlike being on Google or Facebook, when a customer goes to a large enterprise to consume whatever service they offer, it's always for a pretty narrow purpose or narrow sort of expectation. So when you want to offer an incremental or an adjacent service to them, it's got to be incredibly relevant to that need that they've got. If it's not, you won't get the performance that your venture's after, and frankly, the opportunity cost will be too great for the corporate partner. So again, the scenario we have a lot in X15 Ventures is people coming to us saying, hey, we've got a business or a service that takes a payment or requires lending at some point. So that makes sense. Let's plug it in. And it doesn't always. It's very much about the customer experience and sort of where they're at in that journey and what matters most to them. In this case, conveyancing matters when you're buying a home. It's not something anyone ever gets up in the morning and says, hey, I want to do some conveyancing, but at a particular moment, it matters. So, what does that mean? What was the outcome of that? For a service that is $1,500 for a customer, we're acquiring customers at around $85 per customer, which, we think is a really significant benefit for that venture. Let me touch on another one. I'll keep moving. Unloan. It's a low-cost digital direct home loan business. It's what we sort of think of as a flanker brand to CommBank, a little bit like people will be more familiar with the sort of the Jetstar to the Qantas model. So it's got less of a value proposition than someone who wants a sort of full service bank relationship, including branches. But for a segment of customers who want to get the savings of a digital direct service model back in their pockets, it's ideal. We launched in May last year. We think we're the fastest growing lender in our category. We've only shared one number to market, which was back in January. We had $1.5 billion in fundings on the platform in the first 8 months. We're accelerating from there. Obviously, unlike Home-In, different story here when we're talking about unit economics. Unlike Home-In, we're not going to plug that into the CommBank app. I'd get in a lot of trouble with peers at CommBank. But we do think about ways that enterprise partnership can help Unloan. And, in this case, the partnership benefit is accessing the brand of CommBank. And I think this is one of the really interesting learnings for us is how significant that has been in helping the business. This is something, actually, I remember the focus group research we did. I also sort of have seen some of the results on sort of affiliate sites and in media and sort of some of our brand spend. The association with a bigger brand drives both a broader set of customers interested in the proposition, but it also helps people get over the hump of sort of consideration to convert. So another learning for anyone thinking about ventures that are possibly partnering with enterprise, an enterprise won't, or certainly an enterprise shouldn't, lend their brand. You've got to create or sustain value for their brand, or they won't let you go near it. So, in our case for Unloan, we very explicitly say that it's built by CommBank, and because that's true. The business model, which I'll show you in a second, is architected in a way that most of the core services, the compliance for Unloan, plugs into a set of APIs that are consumed from CommBank. So brand is great, incredibly beneficial for attracting customers. I think, very candidly, one of my initial thoughts was, hey, this is a bit of an edgy brand targeting a slightly younger and specific demographic. Are they really going to, is the CommBank brand going to resonate as much for them? I was surprised by how much of a difference it makes. So, the learning is, brand association is great, but you have to earn it. No one in a big enterprise is going to give that to you lightly. So again, we talked about when you're thinking about unit economics, there's how are you going to acquire customers at a reasonable cost? And then, of course, how are you going to serve them, exceptionally, but also at a reasonable cost? Now, actually, our cost to serve for Unloan, we believe, is haven't verified this, but think it's incredibly cheap relative to our peers. It actually is a small portion of our total cost relative to that cost of bidding on the same keywords out there on digital platforms. But still, we've got to get it right. And for Unloan, that comes through, again, technology. We're assisted by some really great local fintechs here. And, the experience for a customer to verify that they are who they say they are, to help them sort of complete their income and expense statements, and ultimately to, submit documents required and get their application in. All of that takes as little as 10 minutes. And shortly, we're going to be in a place where actually some of the decisions can be made straight through without human intervention. So, most importantly, above and beyond all of that, customers really love Unloan. It's got an NPS. Again, you'll notice we think a lot about NPS. It's got an NPS consistently sitting in the 60s. Scalability. That's sort of the next phase. You've got unit economics. How sustainable is your venture? Obviously, that ties to unit economics, that you've got an efficient model. but it's also about how robust your model can be through the cycle. Look, for us, we think X15, has a lot of help that it can offer here. We have a model, which I sort of touched on earlier, which means for a business like Unloan, our venture architecture is quite unique in that the front-end experience of Unloan is a, fully sort of cloud, digitally native experience that is incredibly, compelling for customers. But then via our APIs, we couple that with the balance sheet, the banking and compliance systems of CBA. And that's a model that we think can really sustain Unloan at serious scale, and candidly, as appropriate scrutiny from regulator sort of turns to Unloan as it becomes a sizable player in the market, we really want that. So that's an example of how we think about scalability just beyond total addressable market. Is it a venture and a business that can endure through the cycle? So anyway, that's a couple of businesses in our portfolio that are sort of probably most relevant to the home space. And hopefully that's brought a little bit to life the way we think about, what you should measure or think about for a venture at sort of particularly early stages as they're growing. I should point out that we do have a program for very early stage ventures called Accelerate, where we effectively bring them in, work with them for a month and sort of tease out, is enterprise partnership the right choice for your venture? The answer in the majority of cases, we believe, is no. But if you find the right ventures for which that's a good pathway, they should certainly look at it. I've also called out on the far right hand of the scale for those that sort of want to have a chat later. Not every partnership that needs, gets plugged into CommBank needs to come via X15. We're a pretty friendly front door, but there's lots of examples of businesses that have much more stable and sort of clear business models that plug directly in. Look, I thought I'd finish with a few very quickly thoughts on enterprise readiness. What I mean by that is we deal with a lot of startups and we try to get them ready to plug them into one of the biggest companies in the country, and you're often taking them on a journey of how they get enterprise ready. Now, I think that's a question that any startup should think about, whether you have any plan to partner with an enterprise. Whatever the exit pathway is, be it listing, be it sale, you'll need to get more mature and more resilient. And I think it's fair to say that if you do any scan of the newspapers from the last couple of months, it's clear that sort of safe is the new sexy. Making sure that from a technology perspective, a cybersecurity perspective, your business that you're invested in knows what it's doing is absolutely critical. There are some serious company killers out there, and that doesn't just apply to public companies. Let me go through these at very fast pace and I can pick it up offline with anyone who's interested. I think it's important to have a risk culture from day one in any venture. If the CEO can't speak articulately about what their major risks are and what they're doing about them, you've got a problem. That doesn't mean they need to go through expensive certification. It does mean they need to have turned their mind to it. I think governance is the real key there. Don't just have a set of boosters on your board. You need diversity. You need scar tissue. Stay paranoid. I mean, we're seeing it right now all the time in the media, these moments where companies fall over, from cybersecurity perspectives. And sometimes modern enterprises are really just an aggregation of third-party suppliers that you plug together, certainly in the sort of cloud environment. So, paying particular attention to them is critical. And then a little bit of a twist on the old sort of move fast and break things mantra. Our view is, yes, move fast, but keep it clean. Particularly, technologists, CTOs, people who come with really clean practices, are very rigorous in how they sort of document what they're doing and why they're doing it. They thrive long time, and it shows up when you're doing due diligence or when you're doing M&A and you're looking for a business that really is built well with good foundations. So that was it, I think, from me. Thank you for your time. For those online, thank you as well. Please, for anyone online, if you want to have a chat sort of more specifically about anything, I'm very happy. Drop me a message on LinkedIn. And I think for anyone in the room, we're going to do a quick Q&A. Is that right? Thank you very much.
Thank you. I just want to ask if anyone wants to ask any questions. Yes.
I get the impression it's just business to B2C, not B2B sort of partnerships you're talking about?
Yeah, it's a great question. We sort of, so the answer is no, but yes, when you look at most of those ventures, they're B2C. I'm sort of not quite sure why we did that when we started, because I think we chewed off the most difficult possible thing, which is bringing consumer businesses, into a bank like CommBank. We'd love to do some more B2B. That's the territory you guys are probably a bit more familiar. That's the more common pathway for CVCs, which is, write a minority check, invest in an enterprise, and look for a procurement relationship with the large enterprise. That's a very common pathway. It's not one we've yet chewed off. We will though in the next year.
Thank you. Any other questions?
Can you elaborate more on the 40% measure?
Oh yeah, sure. It's I'm not a sort of maybe classic sort of startup guy. What it is, it was a guy called Sean Ellis who sort of did a bunch of work on sort of trying to define what product market fit is, i.e. that magic moment when an early stage startup's like, we've got something here. So the 40% test is a very simple question that you ask your customers. I'll get the wording not perfectly right, but it's something like, how disappointed would you be if this product, service was no longer available? And the measure is once you get to this magic measure of 40% of your customers saying very disappointed, you're onto something. There's a bunch of literature out there on that. It's a pretty useful one. Oh, yep.
Yeah, it's the guy, the founder of Superhero. It's an email app.
I think, you're right. Yep.
It's an email app, exactly that.
Yep.
Very disappointing.
Cool. Oh, we've got one more.
Yes. Last one.
Sorry, with the enterprise arrangement, and as you scale and you might need to iterate some of these products, I'm just curious, who takes responsibility for the testing? Is that done at your level, or do you do it in collaboration, or how does that work?
Yeah, it's a great question. The answer is both. So when enterprises are at any, ventures are at any reasonable scale, they've got a risk team inside them. They've obviously got a CTO who would be incredibly focused on sort of getting security arrangements right. X15 effectively runs an extra assurance layer. So we can sort of look CommBank in the eyes and say, no. Primarily, they're doing what they're saying they're doing. And that's where a lot of companies fall over. They'll have great documentation. They'll have a great bunch of sort of providers who help them with cybersecurity. But actually, when you lean in a little bit and actually just ask really straightforward questions, like, can I see what you've documented there? Can I see how you actually are doing that? Can I see how it's working? That's when things start emerging. So we've got a central team that effectively runs a sort of control function over the top of that.
Perfect. Thank you so much, Toby, for such an insightful presentation. And we really, really appreciate you taking the time and coming in and sharing your insights.
My pleasure. It's great to share it. Thanks, everyone.
Okay, so our next segment is going to showcase presentations from some of the most innovative companies in the industry. Each presentation that we will have today will give you an opportunity to explore cutting-edge ideas and explore exciting new investment opportunities. So get ready to be inspired and gain unique insights into the latest trends and developments that are shaping the future of our industry. We are excited to bring you these presentations and can't wait to see what these innovative companies have in store for us. So first up, we have Sam Phillips, CEO of Reach Alternative Investments.
Thanks everyone for your time today. It's a pleasure to be here with you. I'm the CEO of Reach Alternative Investments. We are a private markets access company. We have a laser focus on partnering with the world's leading asset managers with the longest track records and providing access to their exclusive private market funds. And the reason that's important is because for the last 25 years, I've been dealing with institutional investors, the ultra high net worth families who've had access to such funds. And it makes a tremendous difference to a portfolio when you can get this type of access to a fund that might have 20 or 30 years track record of success importantly across multiple market cycles. So what my colleagues and I came together to do was to find a way to lower the barriers to entry to such funds. And the biggest barrier to entry is that you traditionally need 10 or 20 million US dollars to access. So it's really been the playing field for only the largest institutions, the largest endowments, the ultra high net worth family offices around the globe. We've come together, we have a technology enabled solution, and we have the relationships with these asset managers, which enables us to provide access to non-institutional clients such as yourselves and us. What we do is we partner with those who really can demonstrate, no matter what the strategy is across the spectrum of private markets, a demonstration that they have the ability to perform no matter what the market conditions are. And I think it's safe to say at the moment that over the last 15 years, we've been in an environment where most asset classes have performed quite well, most asset managers have performed quite well, but we're now in a very different stage. We've got high inflation, we've got high interest rates, we've got stress coming through the finance systems, and it really is a time to be looking for proven track records. Now, with track record comes size. I have no idea how to use this, but I'll give it a go. There we go. People say, why does size of fund matter? And the reason that size of fund matters is in private markets, to be able to generate a very large amount of FUM in a particular strategy, you've got to have been able to point to a very long track record of success. It's very difficult to raise $5 or $10 billion for a strategy in a private market unless you've got clients who've been with you over time and want to keep giving you repeat money. I think Hugh, my co-founder's favourite saying is that money goes where it wants but stays where it's treated well. So if you look at the graph on the screen now, if you look at the small, medium and large sized funds in the private market space, this is historical data pointing to the track records. Over the last 10 years, I think it would be safe to say that everyone is looking at the top end of those charts and saying that the small managers seem to outperform. Up around 23% is the upside of where you can find diversified funds that are performing very well. As you go down to medium and the larger funds, that upside potential maybe does reduce. But us, our institutional investors, the family offices that we deal with, don't look at that necessarily. They look at the bottom part of the chart and the middle of the chart. And I think it's really important to remember that wealth management isn't about wealth creation. It is about wealth creation, accumulation, and wealth preservation. So when we're looking at the funds that we believe offer all three of those, upside as well as downside protection, it is the larger funds that we want to be associated with. And if you look at the light blue line there, that's the most important. That is the median returns of these funds across all strategies, whether it be VC or buyouts or infrastructure. And the large funds tend to outperform all of the other funds combined. That's where we'd like to be. That's where our relationships are now. And that's where we think the best opportunities are to truly diversify a portfolio with a level of downside protection. Okay, our three existing partners that we have at the moment are Apollo Global Management. They are a legendary manager, one of the largest private credit fund managers globally, $515 billion under management. They have a special situations fund, which is designed specifically to benefit from stress in the European finance system. It was an idea born out of the GFC, as they saw that stress was going to be coming in. They're incredibly well experienced in this space, and they're targeting gross returns of around 20%. It's a fund which you would normally need $15 million US to get into. We're providing exposure to that fund for $50,000. EQT is not equity trustees. It is EQT Partners or EQT AB out of Sweden. It is Europe's largest buyout fund, not a leveraged buyout fund. They concentrate on mature companies, which are good, and they concentrate on making those great. They have been around since 1995, and have generated gross returns in excess of 30% a year over the last 28 years. That is without the risk of going to the lower end of early stage VC. That is mature companies, a track record of a very experienced team, generating returns which would rival, if not beat, most diversified VC funds. And then PGIM Real Estate, most of you wouldn't have heard of PGIM. It is the asset management arm of Prudential Financial. It's a $1.2 trillion US asset manager. We have access to their US private equity real estate. They've been around for over 40 years with this strategy, an incredible track record of success. They are the number 2 real estate investor globally, and they're targeting returns of 9 to 14%. These 3 funds are all closing in the next couple of weeks. They generally only reopen a new iteration of the fund every 4 to 5 years. So in 2 weeks, it will be closed off. There won't be any further opportunity to come into these. I think the real takeaways that I'd like to leave you with all today is that Reach Alternative Investments, we are a technology-enabled wealth platform. We provide access to top-tier funds at lower minimums. That is no longer just for the ultra-wealthy. It is now for us to be able to come in and truly diversify our portfolios, position ourselves in a way that sets us up for a better retirement, and adds that level of downside protection that you don't find when you're either investing directly in startups or companies, or potentially with a boutique manager who doesn't have a real track record to exclude luck from their numbers. We offer an institutional level of due diligence. It is a very thorough due diligence process conducted by my head of investments. He's ex-Russell Investments. He's been doing this for over a decade for institutions and pension funds. We provide an assessment report, which is non-advisory, but it does let you know what we've looked at. We've spoken to the portfolio managers, and we provide that as a service to you so you can make up your own mind if these opportunities are right for you. And perhaps more importantly, we provide regular, repeatable deal flow from 10 of the world's largest asset managers at $50,000 minimum, so you come in and curate whatever you feel suits best for you. So if you do have any questions for us, please come over and see us. I think we're at booth 29, or if you're online, reach out to us through the Chris platform. We'd welcome any opportunities, and I hope to speak to as many of you as possible today. Thank you.
Thank you so much for your presentation, Sam. Now I'm excited to introduce our next speaker, Brenda Lyons, who's the head of private investments at Perennial Partners.
Thanks, Rhythm, and thanks everyone. Welcome to the conference, and for those online, thanks for joining. I'm going to talk about 3 things today. I'm going to talk about Perennial firstly, then I'm going to talk about our investment process, and thirdly about a fund that's open at the moment. There's a few slides to get through, so I'll go through quickly, but I'll be around after this for any questions that anybody has. So for those of you who don't know Perennial, it's an investment management business that was started here in Sydney. I've been running now since the year 2000, so 23 years in investment markets. We've got over $7 billion under management across about 10 different strategies. Perennial Partners is our parent company, and we have a number of boutiques that operate underneath that. The business that I run is Perennial Private Investments. We're the manager on a group of private growth funds and pre-IPO funds. We've got around $700 million, a bit over $700 million under management. We've been doing it for more than 6 years, and we have 6 different funds that invest privately at Perennial. You can see the numbers on this chart. We've made over 90 investments in those 6 funds over the 6 years, and we've already had a third of them go to IPO or private exit, whether it's a takeover or a private sell down. We have a team of 5 people. It's a senior team. This is the investment committee. We have a couple of people that work underneath the investment team. It's a senior team. They're all a portfolio manager level with many years in the market. And I think what's important when you look at the team and understanding the success in running a strategy like this is you need people with experience in private markets, people with experience in public markets, and transactional experience. You need to be able to know how to run an IPO or an M&A process if that's the pathway the company's on. And we have that across our team with our diverse experience. The private fund evolution. So I talked about how Perennial started in 2000. Really, our mission has been to find parts of the market where we can find great returns for our investors. So we started in large cap listed ASX companies. moved to small caps, micro caps, and then in the last 5 to 6 years, we've moved into the private growth and pre-IPO part of the market. We've been launching about a fund a year during this period. The demand has grown. We've effectively been the pioneer in this market with the largest player in this private growth sector in Australia. And the fund that's open at the moment, the one we launched last year, and I'll talk about it a little later, is PPV. The other funds are all closed at this stage. So where do we invest? We're investing in what we call growth and scale, or private growth part of the Australian market. It's an area that's evolved in the US over the last 10 years and evolved in Australia over the last 5 years. So we're not doing venture capital. We're not interested in investing in startups and early stage companies where there's a lot of risk. We're not looking to invest in traditional private equity, which are often investing in more mature businesses with lower growth. Or obviously, and we have other funds at Perennial that invest in ASX listed companies. So the growth and scale stage, which is what's represented in the purple rectangle here, is where we think the best return risk trade-off exists in the market. You can buy companies at good valuations, which are growing very quickly, and then get them through to a successful exit and make good returns for our investors. One of the unique things about Perennial is our ability to be a life cycle funder for these companies. It's very different from other private strategies you may be familiar with. We operate in the private growth market with our new PPV fund. We have our triple P funds, which are the Perennial private to public funds. We have 3 of those, which we've launched previously and are now deployed and in realisation mode. And then we also have a very large listed equities business, which I talked about earlier, over $7 billion in listed equities. So we have the ability to fund businesses all the way through and be their partner, right through from private through to the IPO, if that's the path they're on, and then and through to listing. No other institution in Australia is doing this at any scale, and it's a key differentiator when we're talking to founders and owners of private businesses. Many other private investors are looking to exit at the IPO, for example. Often creates issues. I think we've all probably owned IPOs that haven't gone too well because of there being a large sell down at that point. We're the opposite of that. We're looking to find businesses we can invest more in and hold them as public companies, and that's a key driver of our competitive advantage in the marketplace. So this gives you an idea of what we invested in. We are predominantly Australian-based businesses. We have the ability to invest in some offshore. Around 20% of our companies have been offshore domiciled over the 90-odd companies we've invested in to date. But they need to have a strong linkage back to Australia. It's an Australian founder that's moved to Asia, that moved to California, that moved to London, or they're looking to list on the ASX. We're certainly not looking to compete with offshore-based funds in their home market. It needs to be that strong. But 80% of the companies are Australian domiciled. They're private growth and pre-IPO businesses. You can see around half of our investments have been in pre-IPO, so often a convertible note for a business coming into a listing or other transaction. The other half have been in private growth, or unlisted growth, which is when we're investing as equity. Often you get better upside by owning the equity than owning a convertible note into a transaction. And on the right-hand side, the sectors we invest in. The simple way I think about it is we're investing in the growth parts of the Australian economy. So there are areas like healthcare, there are areas like software, high-tech manufacturing, tech-enabled services, marketplaces, and so forth. And so, once again, a more diverse portfolio than you would get, I think, in early stage VC or traditional private equity. So our competitive advantage, and I've touched on a few of these points, we have a very extensive network. We were the pioneers in doing this. You can think of how many companies we've invested in the time we've been doing this. We've enabled companies to stay private for longer. The founders, the investors in our funds, our professional contacts means we get the opportunity to look at things first. We have the opportunity to do them exclusively, or at least cornerstone the valuation and terms, and that's critical in this part of the market. Lifecycle funding is a real key differentiator. No one's doing that at scale in this market. Portfolio management, which I'll touch on a bit more with the new fund, but we think about returning distributions early, returning capital early to investors. These aren't 10-year funds where you're waiting for all the performance at the end. We think that's important. And the team is, as I mentioned earlier, is an experienced team with backgrounds in both private and public markets and transactional and corporate advisory experience. So this is the new fund that's open now. I talked a bit about portfolio construction. This is something that we think is unique and probably comes from our heritage of looking at public markets as well as private markets. We are trying to layer the portfolio to ensure that returns are smoother, eliminate that J curve, that negative J curve, which you may be familiar with, which exists in a lot of private strategies, and getting distributions back to investors earlier. So early wins are businesses which are 1 to 2 years. We have a lot to a realisation event. We have a lower return expectation there. The core is really what we're trying to. That's a quarter of the portfolio. Half the portfolio is in the core. what we're trying to solve for. This is what we're trying to solve for here. Companies want to stay private for longer, get a lot bigger. We'll always have companies that list on the ASX at 20 million or 50 million. That's always going to be part of our market in mining exploration and maybe biotech. But there's no reason for other companies to list that early if they can take on an institutional investor, stay private, get themselves a lot bigger and better, make their businesses more stable and have a more successful IPO. And that's what we're providing capital for. They now have that choice where perhaps they didn't in the past. And so that's half the portfolio is in those portfolio core private growth investments. And then we have some outsized returns. We've been able to make 5 to 10% returns, 5 to 10 times returns on some of the investments in our earlier portfolios. And that's going to be part of this portfolio, this new fund as well. So why now? Companies are staying private for longer. I've said it a few times. We think that's a good thing for the market. The pipeline we're seeing is enormous. We log all our meetings. We had 900 private company meetings last year. I think we've all probably seen in private investments and looked at them directly, normally with mixed success in my case. So this gives you a way to do something in an institutional, systemised way and benefit from us. We're investing in 2 to 3% of the companies we're seeing. So just picking the best from that group. We aren't funding growth, so we're looking to grow these businesses by putting company money into the companies themselves, not secondary trading, which is obviously you can get on the ASX. The markets sell off, and what we've seen in the last 12 months has made companies' terms and valuations much more attractive. So this is just a great time to be deploying capital into this market. I'm almost out of time, but this is the term sheet. We've also got this available at our booth outside, so please come and have a chat. I'll be there for the next few hours and over lunch. So if you want to chat through this fund, we are looking to close it in the next quarter. And with that, that's our sales team, which you feel free to contact. A few of them are here today, or you can happy to contact me directly. But thanks everyone for your time.
Thank you, Brendan, for your informative presentation. Now let's welcome our next speaker, Andrew McVeigh, the Managing Partner of Remara.
Thank you. My name's Andrew McVeigh, Managing Partner of Remara, and I'm here to talk about our private credit income fund. So a little bit about Remara. Remara is an Australian alternative investment asset manager. We manage more than 600 million at the moment across 3 primary verticals. So we invest in private credit, we invest in tactical opportunities, and what that means is essentially private equity for financial services businesses, and we also invest into real estate directly. So we're co-invested. That's one of our biggest differences. In every single fund that we have, we are invested, and in our private credit strategy that I'll talk about today, we own the underlying origination businesses, and we invest into every single loan that we write. In terms of the fund that I'm speaking about today, it's our private credit investment fund. It's a registered management investment scheme. It's managed with Remara. It's got a responsible entity of Melbourne Securities. Currently, we've got management fees of 85 basis points for balances under 250K and 50 basis points for balances above 250K. It's just received a very strong fund rating from Foresight Analytics. So that's the second highest fund rating that Foresight provides. And some of the key benefits of the fund is it's got monthly distributions. We provide quarterly liquidity. It's a floating rate investments underneath. So with the RBA changes and rate increases that we've seen over the last few months, we've been able to increase our returns and ensure that investors are not left holding the bag in terms of RBA increases. And at the moment, post fees, we're currently achieving 10.6% on a per annum basis. In terms of the underlying credit that we invest into, we've got a very, very diversified pool. As I mentioned, we own a majority stake in a number of the originators that are originating credit into our fund, and essentially that's across a number of verticals. So asset and equipment finance is the largest exposure we have on the book at the moment. That's coupled with business loans. Both of those 2 loans are essentially principal and interest style loans over a 3 to 5 year time horizon. We've got high velocity loans in terms of trade and invoice finance and also insurance premium finance. And then we actually couple that with real estate exposure. So where a lot of private credit investment funds are exposed primarily to real estate, the Remara fund has a very diverse set of underlying credit. And what that essentially means is it limits concentration and limits obligor exposures. So our fund at the moment has close to 9,000 individual contract exposures, for which we've placed a 5% first loss for each and every single one of those investments. So what that essentially means is any loan goes bad, we will lose our first 5% before any investor will lose their money in the private credit fund. In terms of how we fund ourselves, we're an institutional lender. So we've got a number of warehouse funds with some of the major big four global investment banks, and we've got a number of private placement arrangements with major fund institutions. This is our first wholesale investor fund that we've raised, and we're seeking the opportunity to essentially provide a opportunity in private credit to wholesale investors that they don't normally gain access to. In terms of the fund advantages, there's quite a few. Liquidity management for us is very critical. The ability for us to be able to manage the origination pipeline, the pool of assets, the term of the underlying loans means that we're able to provide quarterly liquidity to investors, but also monthly returns to investors. The mix of underlying loans means that we can provide an outsized yield opportunity, but mix that with a very, very diverse loan portfolio of more than 9,000 loans. So we've got limited concentration risk, limited risk of losses, and limited obligor exposure. As I mentioned, we've got aligned management, so we own a majority stake in each of the origination businesses, and we invest the first 5% in every single loan that we originate. So when we're writing credit, we lose our money before any investor, whether it's institutional, whether it's a private credit fund, or whether it's any of our other investment partners, we lose our money before anybody else does. So that creates an absolute razor sharp focus on credit and ensuring that we're bringing the right risks onto the book. As I mentioned, we've got a floating return, so a lot of our underlying credit is floating. It's tagged to the RBA rate. So with the last changes and the high escalation in RBA rates over the last 9 months, we've been able to keep the portfolio consistent and that monthly return consistent for investors. As I mentioned, it's monthly with monthly distributions, quarterly withdrawals, and we've got a highly experienced team. In terms of the track record of the fund, this is a fairly new fund that established in August of last year. This graph here, the blue line indicates the monthly distributions. The red line indicates the target return, so that's RBA plus 400 basis points, and the purple represents the RBA return. So we're getting outsized gains in comparison to the RBA rate, and we're getting outsized gains at the moment in compared to our target return hurdle. We're achieving that through our ability to be able to identify strong, rational credit and be able to write that credit and provide returns to investors without suffering losses. Our underlying credit strategy is prime. So we only lend to prime borrowers. All of our loans are secured and all of our borrowers need to have credit scores that put them in the prime category. So that essentially means we're lending to businesses that are bank credit quality. That's a very big difference in terms of most other private credit funds. And as I mentioned before, we do not have exposure solely to real estate. So a lot of private credit vehicles who are offering investment returns 10% plus are doing so with 100% concentration exposure to real estate and real estate development. That's a portion of our portfolio, but it's no more than 20% of our portfolio. That limits the risk and also limits the risk of any negative real estate impacts that might come over the next 12 to 18 months. In terms of the fund performance and historical performance of Remara, we've had a number, and this is probably quite hard to read, but we've had a number of private placements. The largest private placement we had is at the bottom of the page there, and that's a consistent return you can see there from an annualized rate of between 8 to 9%, and that's why the RBA rate was 0%. So essentially that's all of our active gain. Our current fund, as I mentioned, is earning 10.6% net of fees, and we currently have a credit trust that's in market at the moment, which is a fixed rate return, which we've been able to achieve 6%, which is the target return for that. In terms of the team, obviously Andrew McVeigh, managing partner. My responsibility and history is I was with Brookfield Asset Management, CFO for their Asia Pacific platform. My major remit was across real estate, private equity, as well as their corporate operations. I mainly look at fund management, risk management, and capital planning and portfolio management. David Veyor is my partner in the business. He's got 25 years in terms of capital markets. He's done a number of securitization transactions, and he's also founding partner of Grow Finance, which is one of our origination businesses. David writes the credit and has a keen eye in terms of ensuring we're bringing the right risks onto the book. So that's all that I was going to cover today. We do have a stall outside. I'd welcome anybody to come up and ask any questions they'd like. Always happy to answer questions specifically on the fund, the company, or our strategy.
Thank you so much, Andrew, for your presentation. Our next presenter is Jackie Bloom, Growth and Investment Director at Startupbootcamp.
Push this down. Are we ready to start? Yeah, great. Good morning, I'm Jackie Bloom, and I'm here to represent Startup Bootcamp and the Sustainable FinTech Fund. Hope you've had lots of coffee, and let's get started. For those who don't know Startup Bootcamp, we are one of the largest industry-focused accelerators globally, situated in Europe, APAC, and the Americas. Is this working? Now it is. Full disclaimer, the information I'm sharing with you today is not intended to be financial advice. However, you are welcome to invest.
Right now, your money might be invested in projects that go against everything you believe in. Your money might be fueling the climate crisis, supporting animal cruelty, or even aiding addiction. What happens next is up to you.
Where you invest your money and how you impact the globe is now in your hands. Thank you to Bank of Australia for sharing this information and powerful video with us. You're doing it? Okay. Back, please. Back again. Oh, okay. Right. We will change this slide somewhat, so please excuse the changes. So I'm going to introduce firstly Startup Bootcamp. We are, as I mentioned, founded in 2010 in Copenhagen, and Trevor Townsend, our CEO, brought it out to Australia in 2017. We ran our first program in 2018. And next slide, please. So we are incredibly proud of the startups that we've worked with to date. We've invested and accelerated over 1,500 startups globally. We are incredibly proud that 76% of those are still active, 41% are female-led, a number very close to my heart, and 72% have gone on for follow-on funding. Next slide, please. So how do we do this? We have a proven model that de-risks and accelerates our startups. We get our startups pitch ready, investment ready, and commercially ready. Essentially, we unpack their business model and we rebuild it together so that they're ensuring that their companies are scalable, stable, and sustainable. He's got this down pat. Love it. Thank you. Okay. How do we do this? Well, this is really exciting. We have some secret sauce, so I can't share all of it. But we do have a fabulous scouting team in Melbourne and some important IP software that we use. We scout between 20 to 30,000 early stage startups globally. We take that through, or go through a process of elimination. We do due diligence, we look and have lots of interviews and run lots of questions, and then we get it down and narrow it down to the final 20. And that's where you get involved. We invite our investors to come along and actually help with selection days. From 20, we take it down to the final 10 together with your input, and those 10 come through our cohort. He deserves a slab, I tell you. So our team, we have a core team. We are an 18-strong team in Melbourne for our Australian team. We are made up, the core team raising the fund, myself, Richard Selm and Trevor Townsend. And I dare say that between us, we have 85 years of business experience, aligning with startups, investment, angel investment, mergers and acquisitions, and a little bit of army tapped in there as well. The team behind us are all industry experts in their fields, and they're probably watching today, so hi team, and really excited that we're backed by a very strong support team as well. Next slide, please. Okay, so the challenge. We know globally that according to McKinsey, $5 to $7 trillion is needed to be spent and invested into sustainability. That's extraordinary. We've looked at those numbers and we've found that actually it equates to approximately investment into around 170,000 early stage startups to achieve the SDG goals by 2030. The challenge is huge. It's hairy, it's audacious, and I dare say it's certainly diverse and inclusive, and it doesn't discriminate. So what do we need to do? We need to make a start. We absolutely need to make a start. So for Startup Bootcamp, I have and are presenting our $5 million sustainable fintech fund. We will take 30 early stage startups through our accelerator program, focusing on the UN SDGs, and we will impact the globe with our startups that we work with. Next slide, please. So what is sustainable finance? And thank you for asking, that's a great question. Sustainable finance is an organisation that can have an impact on or be impacted by the ESG considerations, so environmental, social and governance. We believe that the industry is hot. It is going to be bigger than blockchain. It's going to be bigger than buy now, pay later. And although some of you may have heard that funding for fintechs may have decreased over the last couple of years, in actual fact, funding for sustainable fintech has increased by 88% between 2021 and 2022. CB Insights tells us that. $30 trillion, according to Boston Consulting Group, has actually been, $30 trillion has been allocated for investment into sustainable outcomes. That figure was reported in 2018. We know that it's now on track to be $53 trillion between now and 2025. So why sustainable fintech and how did we get to our core themes for Startup Bootcamp? Well, this is not our first rodeo. We've already run 3 fintech programs, and we identified that year on year, those startups focusing on sustainability grew incredibly. So we focused on the UN SDGs and we worked out, well, how can we further impact this? So we found 8 of the UN SDGs really had a core significant focus between the intersection of sustainability and fintech. We've taken those UN SDGs and we've broken them down into 3 key themes, and they are financial well-being and inclusion, sustainable business practices and communities, and financing sustainable growth and resilience. Our achievement to date, we are incredibly excited and proud that the oldest fund back in Europe has been returning a 57% IRR. So what does that mean? We know we have a proven model, we de-risk and we accelerate. And the opportunity for you today, here's the exciting part. You get to invest into 30 early stage startups, a $5 million fund. We are looking for a target multiple of 3.3 times, and we are looking to achieve a target of 31% IRR. So my invitation to you today is, as an investor, you're welcome to come and have a conversation, invest in our fund. If not for you, then perhaps 2 or 3 people in your network might be interested to hear more about our Sustainable FinTech Fund, and we welcome any warm introductions. Next slide. So I'll leave you with this thought. Rather than question, should you invest into sustainable fintech and into our fund? My question and invitation to you is, can we afford and can you afford not to? I'll be at stand number 37. Trevor, our CEO, will be joining me, and we would love to have a chat. Thank you.
Thank you, Jackie, for such an insightful presentation. Next, presenting on stage is Giles Ganeswera, CEO at Global Impact Initiative.
This on, or did you want to? Oh. Great. Well, good morning, everyone. I would like to acknowledge the unceded Gadigal land that we're all meeting on today. My name is Giles Ganeswera, and I want to take you through 2 things today. Firstly, a little bit of background on Global Impact Initiative and the work that we do. And secondly, our world first global equities gender equality fund that we've developed in partnership with Robeco. So a little bit of background on the organisation. I established Global Impact Initiative in 2015, and that was after spending 20 plus years in funds management, mainly working for global firms and setting up businesses for global firms here in Australia. Simultaneously, I've served and continue to serve on a lot of not-for-profit entities, ranging from the environment to sport to the arts, climate action, and also human rights. And I was getting increasingly frustrated with my life in the business world, where there's lots of money and very few good ideas, and the not-for-profit world that has no money but has all the great ideas. And so impact investing for me is a great way of putting those 2 worlds together: sustainable financial returns and measurable, actionable, intentional social impact. So our business is focused into 5 main pillars of focus: gender equality, Indigenous communities, health, housing and climate. Gender equality permeates across all our work and our business. 60% of our board is female, 75% of our employees are female, and we're always applying a gender lens to every project and client that we work with. Why gender diversity, and why is it a competitive advantage, and how can you make money out of it? Well, firstly, from a social impact perspective, it gives you the ability to attract and retain the best talent. It's risk and opportunity with a 360 lens, so fully incorporating diversity helps to actually lower the risk. And it improves governance and decision making. And those of you that have been in groups, been in audiences, been on boards in businesses where there's more diversity will know that it leads to better decision making because you have more stakeholders represented in the room. How does investing in gender equality work, and how has it worked? There's been lots of studies that have shown that adding females to positions, decision-making positions, particularly on a board or an executive team, actually increases their share price. So the first chart there on the top left shows the difference in share price from companies that have 0 women on the board in the blue line to the grey line where you have one or more females on the board. And even more interestingly, the return on equity is nearly 5% higher for companies that have 0 female directors compared to 3+. And basically just highlighting that if you add more diversity, if you add more women into decision-making positions, it actually improves the share price, it improves governance, it reduces the risk, and ultimately improves the sustainability of returns. So the fund that we've launched in partnership with Robeco, we've developed in quite a interesting way, which I'll get to in a moment. But firstly, the fund has no exposure to alcohol, gaming, tobacco, weapons, fossil fuels, adult entertainment, plus a whole range of other sectors. There's about 9 different sectors. And as a business, we do not operate, work with, invest in, consult to any of these organisations either. So there's an alignment there. The fund has been constructed to really take the best out of the investment world and pair it with what's happening in the not-for-profit world. It comes in 3 unit classes, and I'll get into those unit classes in a moment. But just to highlight, the key unit class and the one that has the most differentiation is what we refer to as Class B, which is women and girls. And this is where you as an investor go into a portfolio managed by a high-quality global equities manager, being Robeco. Robeco are one of the biggest ESG sustainability managers in the world, and we've partnered with them specifically for their credentials. But they have a track record specifically in gender equality and specifically in global equities with a gender lens of a track record of 7+ years of outperformance. And they have over 300 million under management. And so hence one of the reasons why we partnered with them on this particular product. So when you're investing in a global equities portfolio like this, firstly, we're screening out all the nasty stuff. We then apply what we call a gender lens. So we're looking for companies that are progressive to women in the workforce through having a high percentage of women on the board, women in senior management, family-friendly policies, pay parity, a whole bunch of quantitative and qualitative characteristics. However, in this particular unit class, and there's several unit classes, but in this quite differentiated one, what you elect to do as an investor is your income will then go to one of 5 girls' charities. And those ones that are listed down the bottom there, FHI 360 are our technical partner. So to give you an example, you're investing in our fund. It's a global equities portfolio. Unilever pay you a dividend as a unit holder. That dividend goes to a portfolio, and then we distribute that money out to girls' charities. The major difference being, however, is that we measure the impact of that donation on your behalf. So we're giving collectively, call it half $500,000 to the Malala Fund. Before we give it to the Malala Fund, we will sit down with them and say, what's the social impact that's going to be created here for girls? Specifically, how many girls are going to be educated? What countries? What regions? What year levels, et cetera, and we set up the metrics and we report on that on a regular basis, and we multiply that through the other organisations that we're doing. So this is how we can genuinely and how we've been able to be the first fund in the world that is actively managed and is an impact fund for both women and girls, because we're able to put the best of both worlds together, give you a financial return through a high quality stock portfolio, but through our relationships and through the product structuring, we're also able to give you that social impact and report to you that social impact as well. The other 2 classes are derivations of that. So if you want your income and your capital, you can go into our Class A, but you don't get social impact for girls, but you do achieve social impact for women. And then the Class C we've developed for family offices and foundations that don't require a return, but want to invest into girls' charities and particularly girls' social impact programs. So we've developed a unit class for that, where we can do the reporting, but importantly, we can do the research on what are the best quality girls' social impact programs out there in the world for education, health, nutrition, and social and economic empowerment. These are some of the social impact metrics that we are capturing. So babies' lives saved, number of girls educated, gender equality in the workforce, Indigenous people employed, etc. And as the fund continues to grow, we'll continue to increase those social impact metrics in combination with, obviously, the financial return that you're getting from investing in the fund. So finally, as Ban Ki-moon said, there's no plan B, as in there's no planet B. We need to start investing in gender equality. We need to start investing in impact investing very, very soon. Millennials, according to the World Economic Forum, will be transitioned to them about $40 trillion in the next 4 decades. So we're going to see one of the largest transitions of wealth into an area like ESG and impact investing, where millennials are very focused on. There's a desire for humans to do good, regardless of what you may read or see. And impact investing is already out there. It's an ecosystem solution that exists. It's quite new here in Australia. The model that we've developed is very unique and differentiated, but it's also very accessible. So the fund is open. It's got a $5,000 minimum. It's available in 3 currency classes: Aussie dollars, US dollars, and euro. And we've also established a offshore vehicle for those of you that are able to invest in a UCITS or a Dublin fund. I'll be at the conference for the next couple of hours. You can contact us through our website or through the CRISP app, and also on LinkedIn. So I would love to meet you, hear any questions that you have, and hopefully encourage you to invest in gender equality. Thanks very much.
Thank you, Charles, for your presentation. Next up, we have presenting Diego Altrade, Communications Manager, and Joshua Portlock, Founder and Innovation Partner at Electro Ventures.
Hi, my name is Diego Altrade, and I'm the Communications Manager at Electro Ventures. I'd like to introduce you to our founder and innovation partner, Joshua Portlock. Over the last 15 years, Josh has been an award-winning innovation leader in electric propulsion technology. He started developing drones for his final year mechatronics project in 2005, well before drones were mainstream. After a decade of hard work and a series of mergers and acquisitions, he shifted his focus to manned electric aircraft, starting Electro Aero from 2016. He gave a TED Talk on the state of electric aviation in 2018, sharing the global leading position of Electro Aero and Australia as the world's first and only electric aircraft flight training operator at the time. His drone company went on to be listed on the ASX in 2021, and this should give you some context of how he sees potential in the early stages of tech sectors that become highly scalable ventures in the future. Since then, Josh has been a serial entrepreneur in the field of sustainable innovation, and his portfolio of companies continues to be the leader in enabling technologies for electric mobility in the air, over the water, and on land. He's brought these companies together with teams of industry-leading experts to create a unique investment opportunity for you. Here is Josh to share more with you.
Thank you, Diego. I could talk all day about our disruptive technology, but it is more important to start by sharing why we're commercializing it and how it is an exciting opportunity for you to invest in Electro Ventures. Our vision is a future where every form of transport is environmentally sustainable, accessible, and affordable for everyone, so we can stop burning fossil fuels that pollute our precious atmosphere and oceans. Our mission is to advance sustainable mobility by enabling electric aircraft, vessels, and vehicles to be safe, efficient, rapidly rechargeable, and most importantly, fun. So why should you consider investing in Electro Ventures? We have a passionate entrepreneurial team who understand the challenges of early stage startups and the importance of commercial timing, staying lean, and being mindful of cash flow. Our financial partner Bronson, for instance, helped grow Perth Solar Force organically from the ground up with his 2 co-founders over the last 7 years. They are now the largest residential solar installer in Western Australia and one of the top 5 in all of Australia. Their team of 80 committed experts install over 70 residential systems per week, totaling more than 20 megawatts of renewable power per year, exceeding $25 million in revenue per annum. We also have a diverse team of limited partners and advisors who bring complementary skills in ventures, ranging from environmental and sustainability experts to capital markets and corporate governance professionals. We are founder-friendly and often achieve early entry valuations from our advisory goodwill in opportunities we diligently identify as high growth potential and complementary to our other companies. Our portfolio is diverse, not just in the 3 mobility verticals of air, water, and land, but also horizontally diverse, complementing our core company's focus on B2B tech with B2C end-user-centric opportunities and even peer-to-peer platforms. They are also progressing through a wide spread of S-curve adoption rates, providing a healthy mix of profitability, liquidity, and blue sky potential. We aim to achieve the highest positive environmental impact per dollar invested in Australia, and we're targeting an average of at least 50% compounded annual growth. Some of our companies are already achieving over 100% annual growth over the last few years. We are registered as an early stage innovation company, giving your eligible investment a 20% tax offset and no capital gains tax for holding between 1 to 10 years. Also, we do not charge conventional VC rates of 2% management fees and 20% capital gains fees. I'm investing $2 million into this round myself, so your investment benefits proportionally from the same high growth ambition and risk aversion as our own investments. Our team at Electro Aero have been developing the SAE International Standard for aircraft charging over the last 4 years. From our market research, we believe we have over 70% market adoption of our charging standard, and our sales are currently predominantly exports, with 80% of our revenue into the North American market. Around 70% gross margin on our aircraft chargers sales, with even higher revenue potential from containerized batteries and after-sales subscription.
At Electronautic, we've really focused on revolutionising personal watercraft technology with actively stabilised hydrofoil propulsion systems that we call the Wave Drive. The embodiment of this is in our Wave Flyers, which are personal watercraft that fly over the waves using hydrofoil technology and active stability control systems. The combination of electric propulsion and active stability control system means we can use up to 75% less power than a conventional boat hull to transport over the water, and that equates to up to 4 times more range for a given battery size, or a quarter of the battery size, or some combination of the two. We're also able to go a lot faster because of this lower drag, and therefore we can really have a lot of fun flying over the waves. We're now on our 4th prototype development over the last 3 years, and we're now developing our 2-seat side-by-side sales demonstrator. While our initial market is the recreational industry, and we have a focus on the rental fleet opportunity, there is a longer-term opportunity in government, defence and emergency services as well. Within the rental fleet, there's dozens of expressions of interest wanting to buy fleets of our Waveflower to rent out at beach resorts around the world, and we have interest from large primes wanting to license manufacture our technology as well.
ElectroBase enables grid-independent solar charging of commercial electric vehicles. Instead of paying a fortune and waiting years to get grid upgrades to cater for high-powered levels of solar and EV charging, our containerized grid-independent solar charging solutions allow you to start recharging commercial fleets of EVs from renewable energy sooner and much more cost-effectively. As you can see from our portfolio overview, we have that diversity in air, land and sea, B2B, B2C as mentioned. Please visit our website to learn more about each opportunity. The use of funds is highlighted here, with a focus on the B2B tech companies predominantly, but we will be making sure there's sufficient capital to help each of the opportunities realize their potential. The S-curve adoption is visualized here to show that there's different levels of adoption of new technology at different rates. And the beauty of having a portfolio of companies across a diverse range gives you steady stability as a whole of the holdings company, independent of the challenges with the regulations or public acceptance. Timing is everything with technology adoption, so we will be cognizant of when we pursue each innovation opportunity. We're confident in achieving our target of more than 10x growth in our share price prior to providing liquidity through a public listing, most likely through a SPAC on the NASDAQ market in the US. Thank you for your time, and if you're interested in investing, please reach out so we can discuss further.
To Diego and Joshua for the presentation. Next up, we have Yash Verma, founder and general partner at Empress Capital.
Hi, everyone. It's really great to be here. My name's Yash Verma. I'm the founder and general partner of Empress Capital. Now, today, I'm really excited. You know, we invest in early stage AI companies, and so far, you know, you've heard so much throughout Emergence about how AI is in the middle of everything, and there's just so many different things that we're seeing in this space that really excites us. So I thought I'd give you a quick background, a little background about myself. But prior to starting Empress Capital, I had a technology business in London and Scotland and so I've been commuting between Australia, London, and Switzerland for the last 20 odd years. I exited my software business that I had there, and Empress Capital was born out of that. I also have a high performance coaching business, and we really want to bring that to the venture capital space. And so I'd like to just share with you a little bit about our what we're doing there. And so look, we feel now is a really great time for us to be investing. So I want to start with the question. If you had an opportunity to invest in a technology that's growing over 40% a year, would you do that? And that's what we see happening, and that's what our research shows happening over the next decade. And so that's what we're doing. Our focus is 100% in AI, and I'll cover off really where we focus within the AI space. So, as Mark Andreessen, said in 2011, software is eating the world. But we agree with the CEO of NVIDIA that really AI is going to eat software. And not only is AI eating software, we're seeing, last week, Greg Brockman showed that you could take a photo of on a napkin of a concept, and then through GPT-4 actually generate the code to do that. So AI is not only eating software, it's creating it, and we really see there's some massive opportunities, not just in this space but otherwise. So as an investor, you all know what the great opportunity SaaS has been, and the great things about recurring revenue scalability. So we think that, AI plus SaaS is really going to take that to another level. And, so AI plus SaaS is going to be like SaaS on steroids. And I mean, we've seen this in terms of, if we look at from the model point of view, GPT-3, 1 million users in 1 week. We look at it in terms of 2 months later, 100 million. This is sort of unprecedented, and it really plays back to the days of Google, where we discovered we could start to do all these new things. And so we see this is on a model level, but we see this happening on the application level as well. So whether it be applications being developed on top of those models, and I'll come on to why, what the moats are that we'd need to have for that. And that's some of the things that we really look at closely. So we feel there's a really great opportunity for investors, but equally it takes there's a lot of risks within that if you don't get it wrong. So we're launching a $20 million fund to back early stage AI companies in the AI space. And look, we've invested in many other businesses prior to this, had some really great returns, and we're using that as the basis as well to go deeper in what we're doing. And I'll cover off on our team and what that is. So we focus on 3 key areas. The first being AI-based solutions. And we can see there's a lot of low-hanging fruit right now in terms of automating a lot of processes and streamlining that we have. But we see there's a real opportunity in playing in a space where we don't even know how things are going to be solved, and we're seeing that on a regular basis. I was waiting in the room here today, and there was a founder in the other room. We were just discussing their 3D printing skin or tissue, and we were talking about how AI has implicated their business, and they've said, look, with what they were doing, it used to take probably about 2 days to be able to generate the structures that skin would be molded onto. That now happens within 10 minutes. And so, look, I'm seeing these things on a daily basis. I wake up and I meet companies and I'm like, wow, this is just revolutionizing whatever space from, sewage pipes, inspecting them. And so there's so many different niche cases and opportunities within that. So we focus on solutions, tools. We're looking for the next Atlassian that focuses in the AI space, and we've got some really early stage discussions with some great companies in that space. And the last part is around AI infrastructure. So we look at things around optimizing compute, but equally around key things that are going to really, as AI solutions scale, that are going to be needed. And so we've actually invested in a quantum encryption company. And we believe that identity is going to be a real problem in the future, and we need to solve this. And so these kind of tools will be really used to solve those kind of issues. I'm not going to cover off why I was going to, but I don't have too much time today. But look, AI is outperforming humans. We've just been hearing that non-stop in all sorts of fronts. We're also seeing a lot of compute going up, and we're seeing a plethora of models, both open and private, large, small. The market is massive. We're seeing $1 trillion industry here, and some of the things that were never possible are now possible. And this, just like I say, is continuing and will go exponentially as we go along. So, as I say, where we're at with for example, ChatGPT, and you heard Mike from Google talk about what they're doing, and if you've been following Microsoft, what they're doing. This is just the very, very beginning of where we're going. And in fact, I was going to give you an example of a model that came out of Stanford last week called Alpaca. And just as I was about to come onto stage, I thought I would have a little look. And actually, this was a model I'd really love you to have a look at outside of here. But this was a smaller model that was trained on another model. So a model trained a model and was a lot smaller and could be done for about $500. Now, it's been proven that it hallucinates a lot, but this is where we're going. There are new ways. So it's not just the large players that may dominate in this space. So we're really looking at that. And I think as an investor, it's really important to understand what the implications are in this space. And that's what we aim to do as a fund to give you access to that. So we focus early because that's where the opportunities are. 2/3 of companies haven't even been funded. So the key thing here is cutting through the hype. So as investors, it's really critical. So we think there's more than two ways, but our two critical ways are really around having great quality deal flow. So we have a network of founders and a really proprietary network of being able to access deals that are really exceptional. And so there's a whole heap of founders that we're already been working with for a few years that we're waiting to bring to market. And the other part is a rockstar team, and we have a fantastic team. The team is also, got a lot of corporate experience, both from a corporate advisory. We've got people that have worked with Richard Branson, worked with Wesfarmers Group, the Murdoch Media side of things at a very high level. And we also have a lot of, specialist experience. We have Darren in the front row here, who's our health specialist, who really focuses on AI in health. And we've really got a team that can help our founders. So that's the part of VC is really about not just putting money in. If I had more time, I'd love to talk to you a bit about some of the investments we have made. But all of the investments we've made are actually going global. And that's what we're excited about to grow from Australia. So in a nutshell, we're aiming for a 5x return in the mid-returns in what we look at. It's a 10-year fund, 20 million size. We're putting 5% of the fund in ourselves. And it's a 2 and 20, which is a really standard VC sort of model. We'd love to talk to you in more detail around some of the opportunities we're seeing. But so please reach out to us while you're here in Sydney and equally online through Crisp or directly through myself. So we really think AI is going to be the future, and we would love to take you on that journey with us. Thank you.
Thank you so much, Yash, for your presentation. Next up, we have Peter Mobbs, Managing Partner at 5 Sigma.
Great. Thank you, everyone, for having me. My name is Peter Mobbs. I'm the managing partner of 5 Sigma. We're a growth fund that invests exclusively in the global education technology or edtech industry. So our mantra is really simple. We back companies that create social and economic value. So we're not an impact fund. First and foremost, we're about delivering financial returns for our investors. But we happen to operate in an industry whereby it's very, very easy to measure impact. So if you're looking for a fund that delivers financial returns and a positive benefit to society, then you found it. So just very briefly, what is EdTech? It's really an umbrella term that describes all of the technology that powers education. So it's the hardware, the software, the content. In our fund, we focus more on the software rather than the hardware and the content. And it just happens to be one of the fastest growing areas of technology in the world. If technology has done really well, but if you look under the covers, they're not all equal. So some of the sexier areas, health tech, for example, is growing at about 13.5%. EdTech's growing at about 16.3% CAGR off a massive base. So they're not all equal. EdTech's one of the fastest growing areas. To give you an understanding of what EdTech is, some examples, Duolingo, the app on your phone, Baiju's, the biggest EdTech company in the world in India, or in Australia, a business called Go1, which is an aggregator of digital corporate training. I'll spend a bit of time on this slide because I think it's really important. Why would you invest in EdTech? I've touched on the fact that it's growing faster than most areas of technology, but it happens to be, education happens to be one of the largest industries in the world. And in fact, it's a $6 trillion industry on its way to $7 trillion, and it makes up around about 6% of GDP globally. The problem with education is it's a digital laggard. It's not known for innovation. And so EdTech, or the spend on technology in education, only makes up around about 4% of the global spend on education. So it's well and truly behind the eight ball, but of course that in lies the opportunity. So the spend on EdTech is expected to almost double over the next 2 years to 2025. From 2020 to 2025, it's going from 240 odd billion to 404 billion, so almost doubling in a 5-year period. But when that happens, it's still only going to be 5% of the total spend. So we're just at the very beginning of a long, long run of growth in technology spend in EdTech. So what we're doing is offering an opportunity to invest in essentially the picks and the shovels for the almost $7 trillion industry. We're focused on the late stages, so we don't do any early stage investing. We don't do seed, pre-seed, etc. Our sweet spot is Series C and D. We can go a little bit earlier, a little bit later, but it's tactical. We intentionally focus on the late stage because we want lower risk. We want businesses that will still be there in 5 and 10 years' time. And often when you're investing early stage, you expect to lose money on some investments. We don't expect to lose money on any of our investments. And number two, the path to liquidity is truncated. So we can be in and out of an investment in sort of 3 to 5 years rather than 10 to 14 years for early stage investments. Our edge is really that all we do is EdTech. When you've got your blinkers on and you go deep, you tend to understand something really, really well. I've been a founder. I've had a couple of different businesses myself. I've exited twice and recently bought one of them back from private equity. But this is what I've been doing for 20 plus years. Same with my partner, who I'll come to in a moment. But you have this benefit not only of knowing a subject matter really, really deeply, but you can then pick risk factors better than a generalist investor can, and you can pick winners better than a generalist investor can. So that's really our superpower. The result for investors is that you get a better return. And it's not just me saying that. Cambridge Associates have done long-term studies on this, and their conclusion is that sector-specific funds perform better. There's around about a 3% IRR delta between sector-specific funds and generalists. We're in partnership with a group called Artesian. So Artesian are the trustee of our fund. They're the administrator of the fund. They've got about $1 billion under management, so good quality depth and expertise, and we share some back office and front office responsibilities. I won't go into this, but I've talked about the fact that I've been in the space for 20 plus years and had a couple of different exits, but I will touch on my my business partner, who's I'm only able to announce it now, but my partner is Boris Groisberg. He's a tenured professor at Harvard Business School. There's not too many people on the planet that are better positioned to understand ed tech. He's in the top 100 influencers of HR tech in the world. So he really understands how to pick good opportunities. But more importantly, when we have a portfolio company that needs support, there's no one that I would prefer to go to workshop an issue than a Harvard Business School professor. And I know that because I've worked with him for years, and a lot of people I know have worked with him for years to bounce ideas. So between the two of us, we've got a great team. And then in Sydney and Melbourne, we have a team. So we're a standard 2 and 20 fund like the one that you just heard. Minimum investment is US 250. It's a US dollar denominated fund based here in Australia. I'm personally putting in 5% of the funds, so I've got real skin in the game to make sure that we're aligned entirely with our investors. We're a 10-year fund because almost all funds like this are 10 years. But because we're late stage, I'm personally targeting less. I'm personally targeting a 5-year turnaround. We've already met our first close, so we're looking to close out the fund shortly, hopefully by May. But if you're interested in investing, come and speak to me whenever you're ready. We've made 2 investments. The first one is in the US. It's called Academia. It's an absolute weapon of a business. It's got 16 million monthly active users. I touched on it yesterday. The co-investors are Tencent, True Ventures and Khosla Ventures. So True Ventures and Khosla Ventures being tier 1 US VCs. Our more recent investment is in a business called Go1, based here in Brisbane. It's also a bit of a machine, circa $100 million in ARR. The co-investors are Microsoft's M12, Salesforce Ventures, SoftBank, Madrona again. So we're in really, really good company. If you're investing in our fund, you're investing alongside some of the best of the best. So if you've got any questions, please come and see me. Always happy to chat. You can reach out to me direct or via CRISP. Thank you for having me.
Thank you, Peter, for your insightful presentation. Next up, we have Bruce Dell, the CEO of Hologram Zoo.
Hello, everyone. How do I use this? Okay, so the world has been changing a lot lately, and people ask, what is the next big technology revolution? We've had cars, we've had electricity, mobile phones. According to the media and science fiction, the next big revolution is hologram technology. Our company builds more hologram devices than any other in the world. We build hologram tables, hologram rooms, and hologram walls. We've won more major competitions than any other in Australia. The Mayor of Silicon Valley gave us best technology in the world in 2019. We came second in China's largest technology competition for building hologram hardware. Our customers include people like Airbus, Honeywell, Lockheed Martin, our own military, Saudi Aramco, Bentley, etc. We have 2 divisions. The one is our non-entertainment side, and the other is our entertainment side. On the 10th of December, we opened the world's first Hologram Zoo in Brisbane. So a hologram zoo is like a normal zoo. Gee, that's not working well. Okay, that's okay. You're going to get still shots. You can look it up, hologramzoo.com online. Okay, a hologram zoo is like a normal zoo, except all the animals are made out of laser light. Now, this is very important because cinemas are expected to collapse in the next 3 years. So Disney, Warner Brothers, etc., their movies are now all streaming live to streaming platforms. And so people are saying cinema is over in the next 3 years. Where now do mothers take their children in the school holidays? Okay, so let's have a look at some of the different technologies we've created. So this is a hologram tunnel. Now, a hologram tunnel is where, do you see that dinosaur? As we approach him, we see the front of his face. And as we go past him, we see the side. You wouldn't get that if you were using flat projectors in a big long wall. What we have is a technology that creates real depth. So as you're walking through a hologram tunnel, you actually think things are all around you. It looks like the view out the window in that you can see things at different rates of movement as well as different distances. The other thing we do is a lot more fun, and that's where the animals come up to the wall and then they come through the wall and they come up to you and you pat them. You can't feel them, you put your hands straight through them, but we have this technology now. You can imagine how children are reacting to this. When animals come through the wall, they pat the animal and their hands go straight through them. We have hologram experience rooms. So imagine picking hologram grass and feeding a brontosaurus. Like I said, there's nothing like this in the world. This is the world's highest entertainment attraction at the moment. We've produced 8 pieces of content, and people are, how are you producing content so fast? The answer is we're the only games company in the world that makes our content via AI. So we built an AI system where the artists answer questions. The computer then uses that to make the content for them, and we don't have a single line of code written by a human being. And so we opened up with a ton of content, and this Easter, for example, we're adding another 40% extra content. We have giant holograms. They're lots of fun. People like things when they're big. And we have the patents on giant holograms, hologram bridges, and everything else that we produce. This isn't virtual reality. Virtual reality is where you have screens over your eyes and 40% of the population gets dizzy. Because with virtual reality, if I look there and then I look there, it has to recreate. And so a lot of people don't really like that. The top competitors are National Geographic's King Tut immersive experience. That's just flat projectors on walls. Van Go Alive is also just flat projectors on walls. And the most high-tech attraction in the world is TeamLab Borderless in Tokyo. It's also just flat projectors on walls. If they had hologram technology, they'd be able to have Egyptians and cows and things wandering all around. So we've been asked by the Australian Museum here in Sydney to do the world's first hologram dinosaur show. It will be a 50-day show. It will begin in September. And we don't want to lose that momentum. So as I said, we've already built a very successful hologram zoo in Brisbane. We're here today to try and raise money to build one in Sydney. So after the Sydney dinosaur show is done, people go, well, where do I go? I need more of this. And it'll be ready to collect them all. Sydney dinosaur show is expected to do 200 people an hour. Okay, so our hologram zoo in Brisbane has done about 200,000 in 30 days. We were running at near to 100% capacity. We're now trying to increase the size 2 or 3 times. Oh, and we sold every ticket. We opened on the 10th of December and sold every ticket up till Christmas, 6 weeks before we even opened. 1 in 29 people came back in the same 30 days. 17% of people said, I want to do it twice. And 19% of people say they came because they heard about it from their friends. So that's a good start. However, we're only just beginning. We haven't yet added birthday parties, school excursions, and international tourists, and all of these increase revenue greatly. Yet, there's still a long way to grow. Australia Zoo does 700,000 guests a year, Sydney Aquarium 1.2 million, and SeaWorld 5 million. So how many people go to a hologram zoo a year? We don't know. We expect to open more than 1 per capital city because birthday parties alone, we think, you should have 1 for every 500,000 people. So they've only got a half an hour or so to travel to it. How much does it cost to build one of these things? Well, we build all the technology ourselves, and that makes such a big difference. We are going to be able to build a Sydney hologram zoo of pretty good size for only 2.2 million. To put that into perspective, Sega World, built 20 years ago in Darling Harbour, was 80 million, yet this will be the same floor size. The reason why we can produce it so cheaply is, whilst Australia is normally known as being a big farm and a big mine, we've actually built a factory in Yatala and we produce all of our hologram technology ourselves. I'm running out of time. Customers spend about $110 per family. You don't go just once like a normal zoo. Every school holidays, we bring out something new. So you say, I want to go to North Pole, I want to go to dinosaurs, I want to go to Africa. Sorry, not working. There we are. So the parent company, who runs this? So we're about 50 people. We're based in Brisbane. Our chairman is David Merson. He ran Mincom, which was the largest technology company in Australia for 10 years before Atlassian. Our shareholders are people like Leica, people from SoftBank, Oman Royal Family, Morgans, the big financial advisory firm in Australia. President Modi uses our hologram tables. NASA beams from the Mars rover, their scans of the craters. Bill Gates, four-season resort in the Maldives. We built their hologram aquarium. So here's the deal. We want to set up a hologram zoo at cost price here in Sydney. We're going to run it for 9 months, and then we're going to sell it as a successful business. This is quite quick money in and a lot more money out. The idea is the investor gets back their money plus 15%, and then of the remainder of the sale price, the investor gets 45%. We don't know if that'll be 1, 2, 3, 5 million. We're just not sure. But it's a good way to start, and then we can move on from there. So we're opening a hologram zoo in Sydney. We already have a successful one in Brisbane. Sydney Museum Dinosaur Show is in September. We're looking to raise 2.2 million at a valuation of 2.2 million. We'll sell the store in a year, and then we turn it into a franchise, and we move on to doing more of them. The investor gets back their money plus 15%, plus 45% of the remainder, all in about a year to 16 months. Thank you, everybody. I'll be out in the showroom area.
Perfect. Thank you so much for your presentation, Bruce. And I would just want to take a second to thank all the companies that we had here today for their amazing, amazing presentations. And I'm very excited to announce our next session, which will be led by one of our esteemed sponsors. And we are honored to have Stefan Jansen, partner at Pacific Channel, join us today. As a leading venture capital firm, Pacific Channel has been at the forefront of investing in innovative startups and supporting their growth journeys. With Stefan's extensive experience in the industry and deep understanding of the startup ecosystem, I'm confident that his session will provide invaluable insights for all of us. So please join me in welcoming Stefan to the stage.
Hi, everyone. All right, so what I'm going to do today is I'm just going to tell you a little bit about the fund. I'm going to tell you about what we've done in the past, what we're planning on doing in the future. And then I'll leave some time at the end maybe just to take a question or two. So thank you very much for coming. I'm Steph Jansen. I'm a partner at Pacific Channel. Important disclaimer information, none of what I'm about to say constitutes an offer, and we can only accept investments in the fund from wholesale investors. All right, so we're in the business of investing in great people who are solving some of the world's hardest problems in order to create a better future and hopefully make outstanding returns in the process. We're an early stage fund, and we specialize in something called deep tech. Now, I've had a few people come up to me today and ask me, hey, what the hell is deep tech? Right, so deep tech is defined by us at least as a complex problem that requires real expertise to solve. Think typically, career scientists, PhDs, engineers who are working on problems in the fields of biotechnology, medical devices, energy. We've dabbled in conversations going in things like space, quantum technology. Deep tech is not e-commerce. Deep tech is not fintech. Deep tech is typically not crypto, right? We're looking at problems that usually require a lot of expertise in order to build the solution. And we've been doing this since 2004. We think we've gotten quite good at doing this. So just to put some numbers on that, our first fund, and we're very proud of our track record, our first fund returned about 6.8 times money to investors, 50% IRR, net of fees realized after 10 years in investors' pockets. And that was driven by a few of the examples that you can see over there. So for example, Engender, the company at the bottom there, was a 75 times return on money. The way we're able to get that kind of return is because we do something that most VC funds are not willing to do. We're actually willing to go into a university, find IP while it's still kind of in the head of a scientist over there, and then build a company around that person. Now, sometimes that person that is a great founder, that person can become the CEO, and we're happy to run with that person the whole way. Other times, it requires us to actually paratroop our own team to come in, be the early management of the company, and get it to a certain scale, whereupon we become like a little recruitment agency and we find the team that can take the company to the next stage. So for example, just one example of that, this is Professor Cather Simpson, recently appointed to the board of Fisher & Paykel Healthcare. Cather was working at the University of Auckland. We came to her with a series of problems that we were aware of that were in the dairy industry. She put up her hands and said, hey, you know, this one problem that you have on your list here, I think I can solve it with advanced lasers. I'm a physicist. And, you know, we built this company with Cather, again, made 75 times money on this investment, and then hired Cather on as our partner for our next fund and also reinvested in her next startup. So, you know, one of the advantages, as I mentioned, is the willingness to go into university, work with people, reinvest in people who are succeeding, bring them in to advise us, right, and gain their expertise, and just kind of make the best of that. We then raised our second fund. It was a $55 million fund. It's much younger, about 3 years old, but it's tracking right now at about 34% unrealized IRR. We think that will continue to grow. And on the right over there, you can see a few of the companies that are sort of driving that number, right? So Quantify Photonics is a silicon photonics company that is Intel Capital came in and led the round after us, right? So we got a big markup on that one. Vortex at the bottom there is a company that I mentioned on stage yesterday. They're basically creating a spinning column of vapor 8 kilometers tall. It looks like a tornado. It is not a tornado. And they then put a wind turbine on its side in the middle of this thing and harvest it for electricity, right? So very kind of innovative stuff. Coincidentally, Vortex is actively raising, and that's on CRISP, if anyone's interested in looking on that. So, you know, these are the kinds of deals that we do for our second fund, and we're hoping to replicate our success again with our third fund. So we're hoping for it to be a $75 million fund, a lot of the same strategies, kind of just doubling down on what's worked for us in the past. The investment team, you'll see a lot of PhDs over there. Again, that's just a function of what we do. So, you know, deep tech requires often a certain skill set, right, that not every VC fund in the world is able to bring in-house. So, you know, a lot of these people sort of have spent their life working on specific problems, and then they can help us assess the areas that we are interested in. And a lot of these people also bring their own track record, right? So Brent was the former trade commissioner to the US from New Zealand. And in fact, the name Pacific Channel, and I'll talk a little bit about this later, is this idea that we can build in New Zealand and Australia where R&D salaries are, relatively speaking, low, right? Then take the companies to the US, win them US customers, and then immediately raise the next round with American valuations and American customers and arbitrage on that difference, right? So you get an input price that's low, you get an output price that's high. And Brent's history as a trade commissioner to the US, where he helps companies land and expand in the US, is sort of that core competency that we have in-house. Cather, as I mentioned, had a 75x return under her belt. He's a serial entrepreneur, as is Roland Totter. So Roland has had a geneticist by training, sold one company via M&A, one company via IPO, all based on his own research. And yeah, I won't go person by person in the team, but the idea is, you know, skilled PhDs for the company selection and people who can bring in their own skills to also help companies grow. This is the investment committee, a lot of the same people, plus Dr. Gary Pace. Gary, based in San Diego, has had 2 exits where he was sort of the angel investor north of $1 billion now. Really should be fishing, but I think his version of fishing is sort of hunting for startups. Again, I'm just going to kind of skip ahead through some of these. Our team in New Zealand and in Australia specializes in establishing relationships with universities, right, in order to find that IP when it's in a very early stage. We have relationships with all the major commercialization offices in New Zealand, many of the commercialization offices in Australia, and we think this area of the world is uniquely well-suited for some of the deep tech investments that we do, right? So for example, in agri-tech, future of food, New Zealand is a global powerhouse, right? The Crown Research Institutes are globally respected research institutes, big success stories like Fonterra, Gallagher, right? And same deal in Australia, right? There are certain industries over here where Australia really is truly just a global leader. Okay, so just kind of expanding a little bit about what I was talking about earlier, we take companies from Australasia, we send them across the Pacific to larger markets where they can land and expand. We do that in China, we do that in the US. We have an office in San Diego where we do that. And this really was built on a business model created by the Channel Group, which you see over there on the right. The Channel Group is a group that got very wealthy, taking Israeli technology startups and bringing them to the US. Despite this fake American accent, I'm actually Israeli originally. So I know a little bit about kind of that process, and we're hoping to sort of get Australasia to be the next Israel, right? The big tech hub that can take startups to the US. This is what we're looking for, right? And again, this does not constitute an offer, but this is kind of what we're putting out there. And this is all available on Crisp, again. So I just want to end on one project that we're doing over here that is not actually a tech project. So this is a project that we started off as an impact project. The idea was to basically go to underutilized land in New Zealand, plant forests in it. The New Zealand government has something called the Emission Trading Scheme, where once you have planted a forest on your land, the government comes and audits it. They then say, congratulations, you've sequestered a certain amount of carbon. You can now sell this carbon on the open market. And if you're a polluter in New Zealand, by law, you have to buy those carbon credits. So we initially thought, okay, this would be a good way to create a little bit of an environmental impact and maybe make a little bit of money. And our math showed that we could break even when the price of a carbon credit was $5.25. Since then, the price of carbon has gone up from $5.25 to between $70 and $80, right? And this has become such a profitable project that actually we've brought in a syndicate of European billionaires that were riding out the pandemic in New Zealand. And they, one of them is the former founder of Carlyle in Europe, right? So the huge private equity fund, a big private equity magnate. These are hard-nosed investors. They look at things in terms of the return to them. And so they came up and said, okay, actually, we want to invest in this thing. So this is a project that we're doing. Being a VC fund, we couldn't help it. We took an AI company from our portfolio. We're using that AI to identify the best places to plant forests and the best places to then design the schema for the land. And we do a revenue share with the landowners, which in this case are New Zealand's Māori indigenous tribes. One of the huge advantages of doing this is that you actually don't have to buy the land, right? So there's no big CapEx costs in setting up the project, and that's part of what makes it so profitable. All right, we're on Crisp, so all the deals that I talked about, the forestry project, the Vortex that I mentioned earlier, and of course our fund itself, you can see over there. And I'll just leave this up for the last 15 seconds or so in case anyone wants my number or email. Guys, it's been a pleasure telling you a little bit about our fund. Thank you so much for your time.
Amazing. Thank you so much, Stefan, for such an insightful and thought-provoking presentation. Your expertise and experience have definitely provided us with valuable insights. Now, we have a very exciting panel session. Just give us 1 or 2 minutes to get everything set up, and then we will welcome our panelists. Thank you. Amazing. So we are ready for our next session, and this promises to be a thought-provoking discussion on alternative fund investment opportunities. And we are honored to have a distinguished panel of experts with us today to share the insights on this important topic. Our panelists include Alex Simmons, co-founder and CEO of Cascade, Brendan Lyons, head of private investments at Perennial Partners, and Sam Phillips, CEO of Reach Alternative Investments. With their extensive experience in the investment industry, they will provide valuable insights on the latest trends and developments in alternative fund investments. So please join me in welcoming our esteemed panelists, and let's get started with the discussion. Thank you.
Everyone. Hello. Yeah, hi. My name's Sam Phillips. I'm the CEO of Reach Alternative Investments. We are an access point for private market opportunities across the entire spectrum, from venture capital through to infrastructure, buyouts, real estate. Today we're here to talk about the alternative fund investment opportunities. It's a very interesting time, obviously, with what's happened with SVB lately and the stress that we're seeing in the markets. And we thought it'd be a good opportunity to talk about the knock-on effects, what it's actually doing to the market, what the asset managers themselves, the LPs, the investors, and the portfolio companies are going to feel as a result of this, and then just look at the opportunities that we're seeing in the space and open it up to the panel. So I might just start by getting Alex and Brendan to introduce themselves, and then we'll kick off the conversation.
Thanks, Sam. So I'm Alex, co-founder, CEO of Cascade. Cascade provides non-dilutive capital to startups through 12-month term loans. We exist basically to help founders and CFOs access growth capital for their companies really quickly without the need to put together pitch decks and data rooms and without spending much time at all really applying. And we do all of this through our online platform.
Yeah, thanks everyone. I'm Brendan Lyons is my name. I presented a little earlier for those that are still here. So I'm the head of private investments at Perennial Partners. We invest alongside in later stage, I guess, than what Alex is describing, in that private growth and also pre-IPO part of the private market. We've got 6 funds that invest in founder-led, predominantly Australian-based businesses that are looking for primary capital to grow their business, get a lot bigger before they go through to a transaction.
Great, thanks guys. So fairly diverse range of experience here, which is great. Hopefully it'll be a balanced conversation. As I touched on earlier, we've had Silicon Valley Bank collapse in the last few weeks, and we're already seeing some knock-on effects from that. I think it's really worth looking at the environment that we're in prior to that happening. I think it's safe to say that venture capital especially was in a bit of a bubble in 2020-21, and there was already some stress coming through. We'd seen decrease in valuations, and potentially it was becoming a little harder to acquire funding that is so important to early stage funds. So I thought it'd just be worth exploring what the SVB collapse has, what it means, especially for portfolio companies and investors, not only in Australia but globally. And Alex, I'm sorry to throwing it to you, but with your mandate of providing funding to early stage companies, it might be worth starting with you.
Yeah, so look, I think the most obvious point is investors' risk-off mindset might be elongated a bit further. How we end up seeing that at the portfolio company level is a lot of the operators shift their strategies from those kind of moonshot, high growth, high risk things to actually something more defensible. And so we're seeing a lot of companies figuring out how can we actually shift our strategy and our execution to get to profitability, get to break even sooner than we initially anticipated. And as a result, they're changing their operations, they're changing their capital structures, they're changing their operating models. So that's one thing. And then I think there's also a shift in kind of long-held assumptions as well around like what is a kind of risk-free strategy, again, both at the investor level but also the operational level. And so we're seeing kind of diversification taken to a whole new level. On the operational front, we're seeing people, of course, split their bank deposits across multiple banks. Like, who would have ever thought that was something that needed to be taken seriously until recently? And we actually have seen that even in the last few weeks. We've been seeing people immediately set up bank accounts across different entities. And I think that's going to spread to a whole bunch of other things as well, like who you have partnerships with, who your suppliers are, and a variety of other things.
Yep, thank you.
Yeah, I can make a couple of comments. I guess firstly, I mean, there's been a lot written, I think, people across what happened and why it happened with SPV. There was certainly some specific factors going on there. Our direct exposure was miniature to zero from what we do. But I think it's what we're seeing is a couple of things. One is interest rates have risen very quickly globally. We have seen it before, but not for a long time, probably 30 years. A lot of people, I guess, haven't seen it by definition there. And it's going to have, there's all the known impacts or expected impacts around the consumer and the housing market and perhaps business credit and a few things. But what we're seeing is some unexpected impacts from it. I think there could be more of those. And so that's what I think surprised people with this particular situation. But to Alex's point, I think there's no question that what we often say, investing is a bit like being a winemaker. Every vintage is different. There's always something that's happening every year. And the last few years have been completely atypical. I think 2021, I mean, we all remember interest rates were low, capital was freely available. There was capital flying around the world, chasing things, very high valuations and loose terms. Last year, we started to see a reset, quite a significant reset of that in private. We saw it in the public markets, obviously, with what the exchanges did. We also saw it in the private markets where valuations and terms have changed dramatically. I guess what we try to do, we're trying to get businesses quite close to a transaction. So we're always keeping an eye on what the exit is, what the listed market's doing. So I feel like we've made the right investments during that period and not chase some of those valuations. But there'll be I think a bit of a reset there that'll go on for some companies and for some investors, I suspect. But we overall see that as sort of healthy. I think it needed to get down to something that was more sustainable. Businesses are experimenting less. I guess what you're alluding to, Alex, they're focused on their core business. There's been obviously some cost reduction in costs and some redundancies in some of these businesses. Some of the ones we invest in are profitable already, so they can keep growing, but harder to raise money, lower deal cadence, more focused by the companies, valuations and terms are more attractive. So as an investor, now's a great time to be investing in private businesses because you're getting the benefit of all that.
Yeah, look, I think that all resonates with me. Alex, you mentioned about some companies are now able to split their funding between banks. I know that SVB, one of the conditions of getting loans through SVB was that you had to have 100% of your funding with them. A red flag to me, to be honest now, is that they've changed the rules and you only have to have 50% of your funding of your cash with them. However, they're still keeping their entire loan book open to you, and the advisors are rushing to founders and saying, remove half of your money immediately and draw down on every cent of capital that's available to you as a loan. So I do think that some of these knock-on effects have not been felt yet. It is the unknowns and the uncertainty that really knocks these markets. And I agree with Brandon that, I do think there's more to come. So it's really coming down to being very, very selective in who you back, ensuring that you've done your due diligence and just trying to make sure that you remain as diversified as possible. I think on that, I was wondering how the terms have changed in private markets. And when we talk about the terms, how the LPs and the GPs and the portfolio companies are interacting with each other. I mean, clearly there's a lot more caution, but there's also a lot of dry powder sitting there that has to be deployed. And I was just wondering from maybe you, Brendan, how are you looking at the terms that have changed since 2021 as the market gets tougher and people have to do a lot more due diligence around every deal?
Yeah, so there's a couple of things there. I mean, one is, I guess, your existing investments that haven't quite got to maybe the IPO or the exit and are looking to extend their runway a bit. And the second one are obviously new investments, and we see a lot of new investments, and obviously we've got around 60 odd companies across our various funds, portfolio companies that we're talking to regularly. I think we've seen, it's been a marked change. We've sort of, we didn't get a chance to chat about it today. We do follow valuations and get you have various sources of data. What we've seen is that if you look at, say, the technology sector, for example, the valuations are now back to where they were about 4 years ago. So they were very high 2 years ago, and then they came back and at different stages, a couple of the COVID sell-offs, and then perhaps parts of last year they got below the long-term average, but they're getting back to about the average level. So we feel like valuations, but in some cases that means they've halved. So valuations were sort of 2 to, I think in some cases 10 times higher than they should have been for some companies 2 years ago, and those valuations have come back to more normalised levels. That's in the listed market, and I think we've seen that also come back, seen that applied in the private market. With portfolio companies, we've been telling them for 12 months that things are going to be, I mean, the technology sector started selling off in the US 18 months ago. It was before the broader sell-off. We could see some signs there. We follow these things closely, and we said, look, just assume it's going to be a lot harder from now on. You need to extend your runway, get refocused, just cut the experiments, cut back on your R&D and maybe some of the hobby projects if you've got any. And we've seen some businesses actually accelerate as a result because management are just focused on their core business now and less stretched. So we actually think that's been, well, sometimes they've reduced their headcount, but actually accelerated their revenue. So we think that's interesting and probably shows an increased focus. So for those businesses that haven't quite got to the exit because the IPO market's been more difficult or doing M&A's taken longer, they've been able to take some capital and keep growing and get bigger. I don't think it's a bad thing. They can keep growing, get bigger, and so when they get to that final transaction, I think it'll be more likely of being successful.
Alex, anything that you've seen noticeably in the market? I mean, you're a lender or a funder to some of these companies. Are you seeing changes in the way these companies operate or think or are positioning themselves for the future?
I think it's largely a matter of where they're sourcing their capital from. As equity capital has continued to get more expensive, and they are shifting these strategies internally, they're thinking about how can we actually utilize debt. And so it's been really interesting, particularly in the earlier stage. I'm talking kind of, 500,000 to sub 10 million in annual revenue businesses. Last year, they were much more reluctant to have conversations about debt. They were less open-minded around what they can actually do and what they can do for their business. This year, it's like a switch has been flicked and everyone's much more open-minded about it. We're seeing VCs put out messages saying it's okay to consider alternative sources of capital. And so the conversation and that narrative has really shifted in that way. In terms of the actual terms that we offer, and we've seen other lenders offering, we actually haven't seen those shift. What instead we've seen shift is the selectiveness of who we're actually financing. And so we've internally adjusted our parameters to be slightly more conservative. We've got to think really hard about who's going to continue to perform at the levels they have been, what else is going to happen. We've got to think about our kind of bear, base and bull cases slightly differently when we're making these decisions. And so I do think we have, and we've seen much more broadly in the space, a kind of tightening in who we're actually funding.
Yeah, and unfortunately, I think the reality is that now that, the level of due diligence has gone through the roof, the selectiveness, the ability to be more selective as a GP or a buyer, that a lot of these early stage companies that maybe got funded because a rising tide was lifting all boats, rising tide being no inflation and free money, that a lot of these companies won't make it. So yeah, it's a sad reality, but I think, as Brendan mentioned, a reset that we had to have. Maybe switch tack now and have a look at, we get asked a lot, in private markets or private equity, what's attractive now? And it's really important to remember that private markets isn't just venture capital or infrastructure or growth. There is so much more to it. And also when you are going into private market opportunities, that money isn't being invested today, that money is being invested traditionally over 4 years. So you make a commitment to a private equity manager or private market manager, and through to say 2026, they'll deploy that capital. So they're taking some timing risk out of the equation, which is great. But, to my fellow panelists, what do you think about, where are you seeing the most attractive areas in the market for people coming in now to gain exposure?
Perhaps I'll start talking about sectors that we invest in, and also perhaps sectors we don't invest in, which probably tells you what we think is attractive and what isn't attractive. In terms of the things we don't do, we don't invest in any cyclical businesses. So we don't do anything that has a commodity exposure. So we're not doing any mining, oil and gas, agriculture, or direct property. And we also don't do slow growth, things like utilities and infrastructure. So we're trying to find growth businesses. So we're trying to find structural growth businesses that can grow irrespective of the economic cycle. And that's really important at the moment. It was important during the COVID period, and we had many businesses were able to just sort of grow during that period. So that includes areas like software, healthcare, marketplaces, which are sort of digitizing perhaps an old way of doing something, and certain professional services businesses, which have also, people have found a better way, often faster, cheaper, and more effective way to do something that was reforming or digitizing some old school process. So they're the sort of sectors and businesses which can grow irrespective of what's happening around them, because they're such an attractive business proposition to either a consumer, if that's who their customer is, or to a corporate, if they're a B2B business, that they'll grow irrespective of all that. One sector that we've doing less in fact, probably for the last 12 months, has been consumer-facing businesses, so e-commerce and other things with consumer-facing. And we've had one in healthcare that's shot the lights out. So there are certain sectors which will just keep growing, but there's others where it feels like they are more discretionary, and as a result, they're the areas you'd be more cautious on. So we're just trying to find the growth companies, and there are businesses, and we might end up, I'm not the first one to say this, we might end up with a bit of a two-speed economy, possibly during this period, where some things will go really well, other things will be really tough, which are more driven by interest rates or the consumer, and obviously we're trying to focus on those which have structural growth.
Brendan, I'm probably interested to hear your take on this as well, because I've got quite a small sample size, but I mean, in our space, like private credit effectively, or one niche within it at least, we've still seen quite a lot of attractiveness within that. Obviously, whilst rates were kind of closer to zero, private credit was very hot. Now that you can get actually a decent kind of risk-free return, at least comparatively, it's probably maybe theoretically at least less attractive. But we're actually seeing people, a lot of kind of high net wealths, be quite interested in a model like ours. And so for us, for example, we've got a debt facility, and we from time to time sell equity in our business as well. And we get people kind of knocking on our door saying, hey, I really like the idea of getting a fixed coupon and exposure to the upside through investing in your business. Are you guys seeing that too in that kind of world?
Yeah, so we invest both as direct equity and also as in convertible notes, which are a hybrid, which are a bit part debt, part equity, and you can structure these so that you get that coupon and also get the upside. If you don't want to get into the technicals of it on this panel, perhaps we're happy to chat about it with anyone who's interested. We put equity caps or valuation caps in those notes as well. So if the valuation goes higher, you get like an equity-like return. But if for some reason the valuation's down a bit, or the lists and the market's a bit weaker at that point, you get a discount, and so you're protected on the downside as well. So one thing about private markets is most of the investments are bespoke. It's not like buying shares on the ASX where it's secondary shares and you know exactly what you're getting, and it's all very structured and homogenized. We've got 2 out of our 5 investment team, 2 of them are corporate lawyers, and so we spend a lot of time getting the structures right. We think there's a bit of IP in what we've developed in our templates and ways of thinking about it, so that you can ensure that you get some good upside, but also protect yourself against the downside. And that's, in this environment, it's always important, but in this environment, it feels doubly important.
Yeah, thanks for that. I sort of, it resonates with me about not going into to cyclicals or mining, because there's always going to be a cycle there, and it's incredibly hard to pick. For us at Reach Outs, we are sector agnostic. We look for the most proven asset managers depending on what their specialty is. And it can be opportunistic or not opportunistic. And I'll give you an example. We have Apollo Global Management is one of our partners, and they are incredibly opportunistic. So at the moment, we can see that there's a lot of stress in the European finance system, and their strategy is specifically addressing finding distressed prices in quality assets that are sitting on the books in the European finance system. Very, very opportunistic. It's been around since the start of the GFC, but to me, it just doesn't mean that you're only looking for opportunistic funds. We have another partner who has got a 28-year track record of buying mature companies, which they call good, and they make them great. And they look at mature companies in Europe because they see the downside protection of having a company which is already well established with a solid revenue stream. And that's the downside protection, yet they're still hitting 30% IRRs a year over a 28-year period. Not opportunistic at all, but potentially very, very well positioned as a 2023 vintage, as some of those companies will start seeing stress, their valuations will come down and it creates a perfect opportunity. So again, I really think it's about understanding that private equity is such a broad spectrum of opportunities. And it's a huge market. It is, I don't know the number, but it is many, many multiples of what's available in the stock market. And that's why the large investors really appreciate and seek out these type of opportunities. It might just be worth throwing it over to what role do alternative investments play in diversifying a portfolio? And I'm happy to start with that one. Again, there's many different forms of private markets. There are listed and unlisted. We are firmly in the unlisted space because we believe that when you want an asset manager to build long-term value for you, they need to be off-market and concentrating on doing that without worrying about what's the market going to think about our performance in 3 months, because their project might need 2 to 4 years to finish. So the benefit to me of unlisted private markets is that it removes some volatility from your portfolio. And some people say, why does that matter? It matters tremendously to me because volatility drives sentiment-driven bad decisions. And if you can remove some of that volatility, remove the opportunity to make a bad decision, which may affect the long-term growth of your portfolio. But besides that, it also brings in better risk-adjusted returns if you can have a portion of your portfolio away from the stock-driven sentiment roller coaster that we all know exists. And besides that, I think finally, it's the opportunity set. If you look at the number of companies in the world which generate over $100 million in revenue annually that are listed compared to unlisted, it is 1,000x. The opportunity set, which is unlisted, companies you would have never heard of, which are not on the stock market, that these private equity firms have access to. So it's broadening the opportunity set.
Those stats also exist in Australia. You can find them on the ABS website, and we've looked at it from time to time. There's, I think it was companies of more than 10 million revenue. It's about 97% of Australian companies are private. About 3% of them are listed, right? So there's a huge universe out there, and some of them are family businesses, and some of them are never going to take an external investor. But it is a huge universe. I think on your earlier point about diversification, I think everyone in this room would understand the benefits of that if you're a larger investor and obviously a wholesale investor, and you're looking to have a diversified portfolio. So I think that's absolutely true. For example, the sort of companies we're investing in, they're growing revenues at 50 to 100% per annum. I mean, you can't find those companies on listed markets. They don't exist. They're normally much more mature. Some of them are going backwards, and so it's a different growth profile. And often you can buy them in the private markets at large discounts to what public companies trade at too. So you can buy fast-growing companies at good valuations. And if they go to become an IPO, then you'll get that uplift as part of that process. Or if they go and end up selling out via a trade sale or M&A, then you also you'll get that recognised because often they'll be bought by a public company who thinks in those sort of valuation terms. But I think also within the fund, and one thing we try and do is diversify your investments within the fund too. So we have 25 to 30 private companies per fund. We're trying to spread out the duration of it. So our funds are only 5 years. We're trying to spread out the generation of those funds. So you have some that you're going to generate returns in 1 to 2 years, some that can take 3 or 4 years. And so you smooth out the return profile, you smooth out the distributions. And I talked about sectors earlier. Trying to have a diversity of sectors there, so you're not just beholden to healthcare, or you're not just beholden to SaaS software or something. You've got a diversification by, and a little bit in our case by geography as well. Around 20% of our companies are Australian-linked companies, but they're based offshore now, and so we have a bit of geographic diversification as well as by sector and by maturity.
Yeah, and perhaps a little less technical one from the guy in the t-shirt. I obviously deal with smaller, younger stage companies, and what that attracts is a lot of angel investors. A lot of angel investors out there are typically kind of at the later stage in their career, and there's a little something called utility that they get out of these one-on-one investments, because what they typically do is they bring their set of experience, their skills, their network, and their advice to a lot of these operators of these companies. I personally often sit down with my own angel investors, once a month, and basically have consultation with them. We're on the whiteboard, and a lot of them are, investing in what they're passionate about, and they get that diversified return in that utility of what they're doing. I think it actually means quite a lot to a lot of them.
Well, thanks for that. That's a perfect segue, Alex, into the next point, which is how can investors evaluate the risk and return when they're moving into alternatives? I know in the angel space, a lot of investors who are new to this are seeing an opportunity. It seems really exciting, but how on earth do you, as a non-finance person, put a valuation on something without just believing someone else is telling you it's a good deal, and maybe you'd be a good one to start with?
Yeah, so I mean, as a lender, we focus a lot on risk. But for investors out there, when perhaps you don't have the ability to look into things like we do, there are still a lot of things you can do, and it's actually quite important investing in private markets that you do that extra level of diligence. We're not dealing with often we're not dealing with companies that are audited with public commitments, that kind of thing. And the person that's fundraising that you might be face to face with is an extreme optimist, and they're very passionate about what they're doing. And so you really have to check, what they're saying. I think there are a couple of ways of doing that, and largely it just involves kind of getting your hands a little bit dirty. So if you're dealing with a fund you might be looking at investing in, then speaking to some of those portfolio companies, actually picking up the phone and speaking to them, how's that going and what's your relationship look like with them? If you're looking at investing in a company itself, speak to their other investors that they have, speak with some of their customers. There's a bunch of stuff you can do that's a little bit easier than that as well. Product reviews, for example, if you're looking at investing in a company specifically, there are thousands and thousands of data points out there that you can simply get by just Googling something. So a product review is something that we actually include, and you can get kind of aggregated scores on how people are feeling about that product. You can get a bit of a view as to what the net promoter score of that is, and that's quite a good indicator as to the health of the relationship with their customers. Yeah.
I can provide a few insights as well if that's helpful. So I guess what we're investing, it's a later stage, and so the businesses, we sort of have a bit of a rule. If we don't understand it, we don't invest in it. It sounds obvious, but it sort of means, and we have a minimum revenue limit. All of our businesses have products in market. They have a service in market. They've got customers, revenue. Many of them are profitable. They've got things you can analyse in a traditional sense, and because they're private transactions, you get access to data rooms and other things. You actually get more information than you get from a public company. You can do all the financial DD, you can do the legal DD. Some of the things Alex talked about around chatting to customers and counterparties is obviously really important. Site visits, we do all those sorts of things. So it's more fundamental analysis. We're not looking to run the businesses. We are investing alongside founders who are doing that, providing them the capital to grow, and then provide them some of the professionalisation that goes with that. It might be around the board or counterparties, or looking to get them through to the next the transaction. That's where we assist with them. So but we are quite glad that there is a very well developed early stage sector in Australia, because someone's funding ideas, which is great. I think there's 150 early stage venture funds now registered on the government website. So that's not what we do, but it's great that there is a lot of capital there and a lot of funds doing that. Some of them are large, some of them are small, but it means that ideas are getting funded in this country, and you're seeing second generation, even third generation founders going back again. So I think that's a good dynamic we haven't had in this country, I think, until the last 10 years. So we think that's positive, and then obviously some of the ones that are successful from that process and come through and are on a track for a transaction, we meet them at that stage. And there's a lot of other businesses that just skip venture entirely and just bootstrap themselves to a $50 million valuation, and they've never had any institution on their register at all, and they're also looking to go to a transaction, and we get involved at that point as well.
Yep. Yeah, thank you. Look, there was a really interesting summit last week where the conversation with some of the largest global family offices spoke about how they're changing their investments. And the insight was that even some of the largest family offices who have done direct investing over the last 15 or 20 years are now moving to specialist fund managers who have the proven track records, because they just don't have the ability to do the level of due diligence within that expertise that these large managers do. So it really is important to understand that it's a different world now than it was 3 years ago. Not every private company is going to survive, and finding someone who can provide that due diligence to you, or to a family office, or to an endowment is becoming more and more important. Unfortunately, we've run out of time there, so I did have a couple of other points that we wanted to get through, but we'll have to save them for next time. If anyone has any questions for me or Alex or Brandon, I'm sure we'd be very happy to talk to you off stage. But thank you, Alex, thank you, Brandon, and thank you everyone for your time. Thank you.
Thank you so much, panelists, for sharing your valuable insights on alternative fund investments. I just want to let everyone know that it's time for a very well-deserved lunch break. We're delighted to have our sponsor, Flav, provide a delicious spread. So make sure you try it and build some connections, have some conversations, and be back at around 1:15, where we have company presentations and a last session with Peter Mobbs, managing partner of 5 Sigma. Thank you. Amazing. Hi, everyone. Welcome back again from the lunch break. I hope you all had the opportunity to network and connect with other attendees. We are excited to continue the event with an engaging lineup of presentations from some of the most innovative companies in the industry. So without further ado, let's welcome our first speaker of the afternoon, Mark Howard, co-founder of Veyor Digital.
Thank you. Hi everyone, I'm Mark, co-founder of Veyor Digital. We're the preeminent software for managing space and asset utilisation in the built environment. So I'm here today to talk to you about how we're changing the way the world's largest ecosystem interacts on a daily basis and the productivity benefits that we can provide by doing that. So firstly, let's talk about the problem. So if you imagine a really large construction site in the, in the CBD, for example, you might have hundreds of workers up and down the building, all different trades, all vying for the different assets on site. The loading dock, the crane, the hoists, different work areas. To make matters more complex, they're all coordinating with a very vast supply chain. So you've got distributors, suppliers, couriers, logistics managers, drivers, traffic controllers, and plant operators once they hit the site. So it sounds pretty chaotic, doesn't it? Further to this, when the building's actually finished and handed over, the problem doesn't go away. So now you might have a building like this with hundreds of tenants, retail, office, residential perhaps, building managers. They're all trying to manage things in and out of the building too, in different spaces like common areas. So how is all this managed today? Well, our biggest competitor still is that whiteboard there. So most people are still doing it on manual static systems. Excel spreadsheets. Because of this, planning's done in silos. People plan without context of what's actually happening on the ground. So this leads to miscommunication, clashes, delays, and programs being pushed out and loss of productivity. What's worse is there's no data captured. It's wiped off the whiteboard at the end of the day. So there's no learnings, there's no improvement in the actual operations of these buildings and sites. So Veyor's base solution, what we first built out a few years ago was a live collaborative cloud-based scheduling system. So basically this connects the vast supply chain onto one simple, easy to use mobile app. People can log in, they can see when the lift's available, the crane, they can make booking requests, keeps the control with the builder or the managing entity. And what's more, it tracks things live throughout the day. So if something goes wrong, people can quickly coordinate and fix the issue and maintain productivity. So because it's a problem that everyone's dealing with, we've quickly onboarded the largest players in the industry. So in Australia, we have pretty much all the tier 1 and 2 builders as clients. You'll notice these names, Lendlease, John Holland, Multiplex, for example. We've just started moving into the building operations space. So we have the likes of Westfield, Dexus, Vicinity as our users. We're currently operating on the largest buildings and building projects in the country. So our industry, as we've developed the product, we've used industry feedback to continually advance. So we have high value features now that track live GPS tracking of trucks incoming, driver compliance and safety, CO2 tracking, other high value add-ons. Basically, this tangible value can increase the value we provide to our customers, obviously, but it increases our average order size and also widens our market reach. So our most recent data from existing clients says that by combining the planning and coordination benefits with the savings you have in lack of incidents, you can get a 30x return on investment. So where do we want to be? So we want to be that single point of connection for all scheduling and ordering in the built environment. So think of the combination of Uber Eats and Atlassian. So it's a live coordination with dispersed workforce and the live material ordering and tracking. So when you combine those on a single to use, easy to use app, there's a lot of power in that. Long term, we're collecting such a unique, massive data. we believe that one day we'll be able to automate the scheduling and automate that material handling process using AI machine learning processes. So what's the industry landscape look like? Well, there's a lot of workaround solutions, and your Google Sheets and Trello, they can work with small, sort of less complex areas, but nothing like a large construction site or building. It's not going to be able to handle the functionality. So there's a number of global players out there that are getting into the space. I think Veyor sets itself apart by having just a more extensive functionality. We handle the full gamut of logistics management. So that's including scheduling, supply chain connectivity, tracking, safety, for example. Given we're early in the space, we're well ahead of those players that are mentioned there. So we actually think that in the future it'll be a mandated solution that will be required, and we saw that with the Sydney Metro project here. The government mandated a digital logistics solution, and obviously we were successful in that tender. So addressable market, obviously property and construction, two of the largest markets, industries in the world. So we've got a massive addressable market out there. We're just focused on our key Australia, New Zealand, obviously North America, Europe and the United Arab Emirates. So there are key regions that we want to focus in. Serviceable, obtainable market within those regions is 3.3 billion. So there's a lot of room to play in. So if we look at the traction to date, so our revenue's been growing pretty quickly over the last few years. We've sort of averaged 100% year-on-year growth over the last 3 years. Our top 58 customers, or we've got, 58 customers now. Net revenue retention's about 130% with those. So it tells you that our customers love what we're doing and they're increasing their spend. Over the last 12 months, we've moved from a founder-led sales team to an actual internal sales team. So we're getting that engine moving, a repeatable sales model. We've secured our first US clients over the last 2 months. And we're just starting to gain traction in the facilities management space here in Australia. So with those clients I mentioned earlier, it's only a very small part of our revenue now, 14%. We think there's a huge amount of growth in that space alone. So what we've found with the future growth, so we've got a bit of a unique network opportunity with construction. So one construction project, when it finishes, that team disperses and goes on to another number of construction projects. We can get onto those, and eventually we work up to an enterprise agreement with the construction firm itself. But as a construction project finishes, we have the opportunity to move on to that project in the facilities management space as well. That then can turn into an enterprise agreement with the facility manager. Further to that, it's a wide network of users. So, the subcontractors and suppliers that use our platform and makes their life easier on a daily basis, we're finding a lot of the referrals actually come from those groups themselves. So with our expansion opportunities and new markets, we're forecasting to continue to double our revenue year on year as we move into those markets. So what's our immediate plan? So we want to build on that initial success in the US. We want to hire boots on the ground there into 2 key states, Texas and California. We've done a lot of research in those space. We know that the problem is real there and there's no solution at the moment. So we're wanting to capitalise on that. Increase our revenue and facilities management. We want to move that up to 40%. That alone will double our revenue. We want to continue to evolve into the material ordering space. There's a huge unmet demand in that space in our industry. So we want to advance the product in that area. So we're currently raising $2 million. That's on a safe note basis, so at a 30% discount. We've got about $1 million of that committed from existing investors currently. Just a little bit about the team as I finish, and see I'm out of time. So the team up there, we've got a mix of experience from property and construction. Rich, our CEO and co-founder, was ex-Lendlease. Probably the other note, Anil, ex-head of R&D at Citrix, so he leads our tech side, an absolute weapon. We've just taken on Lee, Jasper and Rob Philpott as advisors and investors. They're the 2 most successful construction tech people in Australia, having sold their business for $1.6 billion to Oracle. So that's a bit behind the scenes. That's it. We're out in the foyer there. If you want to come and ask any questions or talk to us, we'd love to chat. Thanks very much.
Thank you so much, Mark, for your presentation. Our next speaker is Chris Nemours, founder of Titel.
Thank you. Hi all. Chris from Titel, founder of Titel. And thank you for your time today. Thank you. I always start with the real estate industry is in a mess. And what do I mean by that? If most of you are in the game with real estate, you'll see that you've got agents up here doing their thing, you've got builders doing their thing up here, you've got marketers doing their thing here, and so forth. And the communication between the two is not really good. And it breaks down in what we call silos. So they try and do something with it. So what we've done is it creates roadblocks and so forth. So what I've done is I've put everyone together on the same platform. So I've got a marketing background in real estate. So we do a lot of marketing for land developers and builders and so forth. So we sat down with them to work out what are their pain points. So the solution came up. So we brought everyone together. So what does that mean? It means that a land developer can communicate with a builder instantly through the platform. A marketer could do the same thing and so forth. So what it does, it brings everyone together and trading as a trading platform. A good example of how a builder would use it. So a land developer can upload all his land, for example, and have all the caveats around it. A builder can upload all his blocks of land, all his designs, and put it into the system. And then our system does pattern matching. So a good example is if you've got a builder or a person using the system and comes into their display home, goes, I love this design, I want to use this on this particular block, it does the pattern matching, and you can put a holding deposit straight away, which will go into a trust account. It could also do offer and acceptance, so you can put bids in and it'll accept it or reject it. At the same time now, a real estate agent jumps on board and he can then white label it, so it's under his brand. And if he can see that property, those designs or those blocks or anything in the system, he can then on-sell it with commissions. So effectively then what you're doing is increasing the scope of the sales for that process. So all of a sudden, instead of having a one-to-one relationship, you have a one-to-many relationships or a many-to-many relationships. So then you can have multiple people selling it throughout the place. Same with multi-residential. So we've got clients that want to upload their whole project in the system. Our system will map it out dynamically. So then you can drill through each level. You can actually find the apartment that you like, and you can put an offer and put a deposit straight through our system. The good thing about this is now our developers are sitting there going, we can then open up agencies around the world selling our project throughout the world. So that, again, is the network effect. We've also got, it's real time, there's live bids, and there's also contracts in there. So they could do the contracts straight through the system. I always get this question, what's the difference between you and realestate.com or Domain? There's a lot. Our business model is completely different. They're very, very good at listing properties. We're very, very good at bringing everyone together and doing business processes. The real estate industry is still healthy. Even though there's a bit of a downturn market, it's expected they'll spend over $1 billion just in advertising. So we haven't launched yet. So we're still at seed, and we've nearly finished the product. We're about 96% or so. But we've already got $11 million in revenue lined up, ready to go. For a startup, we're actually really excited. And we've got one of the largest residential developers, real estate agents, ready to onboard. So the business model that we've put together is scalable. So what does that mean? So if we want to go into a particular country, we're able to adapt the product to the language, to the currencies, and to how they do business through their legislation. And we did that on purpose because we knew our markets were overseas. Australia's a great place, but we actually built this for the US. It's future ready, so we're ready to take on cryptocurrency if we need to. We're also working on AI for certain components of our platform, and we're working on some blockchains for contracts. At the moment, you can do contracts, but it's all your typical digital signage. The market is volatile, and we accept that. But the reason why we think we're good for that particular market is because of that network effect, where instead of having a one-to-one relationship with your agency, you can have multiple agents selling your property. So that opens up a whole range of scope in regards to selling it. We've got a good example. We've got one particular country that wants to put all their blocks of land on it and then sell it through agents throughout the world. They won't even know the agents because the relationship through the platform creates that network effect. We are going to specialise initially on new builds, and eventually we'll go into other areas. And it also increases the salespeople's capabilities. So because of the white labelling, if an agent logs in and can see these blocks of land or the houses, they can sell on behalf of those guys without even knowing them. We've got a great team. Everyone understands PropTech, everyone understands marketing, and so we've got a really good mix of people with experience within the industry. We're in the process of raising 3 mil. That's to finalise the product and give us enough runway to Series A. And obviously on board and help with staffing. It was interesting, and I put that on purpose because I did a presentation to a particular bank, and they said, "Chris, you've just built the Amazon for real estate." I'll leave it at that, thank you. We've got a stand out there and I'm happy to have further chats. Thank you.
Thank you so much for your presentation, Chris. Up next, we have Andre Costa, CEO of homes.com.au.
Good afternoon, everybody. Wonderful to be with you here today. And today I'm going to talk to you about how we at homes.com.au are helping reinvent Australian real estate. So I think we all know real estate in Australia is a huge market. It's the largest individual asset class across the country, but it's also a broken market. And what we're really referring to when we say that is how we currently buy, rent, sell our properties across Australia, and in particular, how we search for those properties. Over the past few years, a lack of investment in innovation by the major monopolies in the space has created an environment with underserved buyers and very unhappy agents. This has now created an opportunity for us to rethink and reinvent how homes are bought and sold in Australia for the benefit of all. Let's take a look at some of the key problems for buyers. Firstly, and I'm sure a lot of you could relate to this, buying a home is incredibly complicated and incredibly stressful, especially for first home buyers. There's an absence of advice, of guidance and of support, especially for those getting into real estate for the first time. Speak to anyone who's tried this journey before. It's an arduous process to say the least. Due to that, 20% odd of buyers end up with some form of regret. That could be overextending themselves in certain areas or just ending up in an area that's not appropriate to them. Further to this, it takes 9 months on average to purchase a home, costing the buyer not only thousands of dollars caused by pricing fluctuation throughout that time, but also the stress and the emotional process of it all. And unfortunately, this all comes back to one point, which is the existing portal sites today provide no real guidance or advice to aid buyers in the buying decision. It's a search and results-orientated type of platform, typical to a web sort of 1.0, web 2.0 type of search model. We're all pretty familiar with it. We need to also take a look at the other side of our marketplace, or double-sided marketplace, if you will, which is our agents. And we believe real estate agents are a huge part of the ecosystem and part of a healthy ecosystem. Up to 75% of the time an agent spends is actually spent trying to get leads, get new business. The majority of the inquiries and leads they get from major portal sites are an absolute waste of time. Vanity metrics, which often lead nowhere. Speak to any real estate agent and they'll tell you about the woes that they experience dealing with some of the major portal sites out there. And probably worst of all is agents are getting squeezed out of the industry due to increased advertising costs. So even in a market like we're going into at the moment, advertising costs are going up, and that's hitting not only vendors but real estate agents along the way as well. So there's a real concentration on a monopoly in the marketplace to the detriment of both vendors and real estate agents. Changing the real estate model, and how did we really get here? Well, very quickly, a lot of the dominance that's seen today is created by a 90s era print advertising model, display advertising type of model. And there hasn't been a lot of challenges or ability to change, nor incentive to change, and quite high barriers to entry for new players to come into the market. What we're moving to now, not just at homes.com.au, but with other players, is smart real estate platforms. Platforms that leverage AI and ML, of course, to do the heavy lifting for buyers and agents, and broadly making the industry better for everyone involved, consumers, agents, vendors alike. The solution? Well, the homes.com.au platform is a smart real estate platform that learns as you use it. It's not a search and leave type of model. It's a platform that tries to understand your situation, your financial situation, key requirements, obviously key attributes about a home, and it learns the more you use it, the better insight it gets to you and your partner or other collaborators. It provides advice to you like a digital buyer's agent. So it's not just a search type of result, it's actually providing you that type of guidance that you previously had to pay for. We're with you through the whole journey. So once again, it's not just a search and leave type of experience. We are with you pre-approval all the way through your search experience right to the very end. And what we do throughout the process is we match you with the right properties, suburbs and agents. So you shouldn't be expected to know every suburb in New South Wales and where you want to live necessarily. You should have a set of key requirements and attributes that you're after, and smart technology and platforms such as ours should be able to match you with those properties and suburbs you may not be aware of, and agents that can provide a quality service. We also provide the ability to search at a more granular level. That could be marble benchtops, hardwood floors, anything that actually is quite an important factor for you in your home and your potential home. And ultimately, providing that level of advice and guidance will get you into the right home and get you in sooner. So like I mentioned, existing portals give you classified ads, and they're very good at giving you classified ads and search results. Homes takes a very different stance. It uses AI and ML to build a profile around you and your partner or collaborators to provide those recommendations and search results and suburbs. The more you interact with it, the better it gets. It's, as I mentioned, sort of like a digital buyer's agent. We also can't forget the agent side of things. Once again, part of a healthy ecosystem. And we need to optimize their ability in this environment. So they're not spending quite so long on lead generation and trying to get new sales. So because we effectively aggregate demand at a consumer level, we can target that to the right agent in the right area. So we open up a marketplace of buyers and sellers directly to agents. This is particularly important in the current market where you're seeing less properties go up for auction and the off-market category is growing as well. So it creates, in effect, a marketplace between buyers and agents. We aggregate the demand on the consumer side of things. We rank propensity to buy, and we serve high-quality leads. So all the agent has to do is focus more on closing the deal instead of trying to have to beg, borrow, and steal to get deals as they want to do currently. What makes us different? What's our UVP? Well, fundamentally, we turn buyer and seller profiles into value. We're really more of a data company, more than a real estate company, and certainly more than an advertising company. Our core business, and where real estate is turning, is the data business, and that's how our business has been founded from the get-go. So we really had that as our foundation, and we use data arguably better than anyone else. Market potential is huge. As mentioned earlier, online advertising is around $1.2 billion historically. We're looking a lot more than just online advertising. Obviously, you have agent fees who are around about $8 billion, but really we're looking at the broader real estate market of about $300 billion worth of transactions every year. So what does that actually mean? Well, there's about 10,400 agencies. We operate on a subscription model to those agencies, and throughout the year we look to actually move into mortgages and insurance and those sort of trail-on opportunities as well. A little bit of our traction, key milestones and so on. So we're focused up to date on the consumer platform and getting agents on board with that platform. So the new version of the platform was released in 2021. Since then, uptake has been quite strong. So 65% of listings are available online already. Importantly, around 6,500 agencies are using the platform today. And we've also signed a partnership deal with Industry Partners Group. So we're aligned to the industry, one of the only portals to do this. The major monopoly is not a part of that group, and that represents the vast majority of real estate brands in the industry. We have a strong team, just quickly. Myself has a background in founding prop tech businesses, helping lead the company. Dan Harper, our CTO, comes from REA and also has a background at MyOb and Xero, so very strong pedigree there. And Paul Simos, Chief Industry Officer, comes from REA as well, and also Move Inc. in the States. All of our team is onshore based in Cremorne in Victoria. So I'll leave it there. I haven't done too badly for time. We are located towards the entrance of the foyer area out there. We've done successful seed and A round raises, so we're looking to do our B round over the next 6 to 12 months. And we're looking forward to meeting many of you and discussing that with you later on today. Thanks very much for your time.
Thank you so much for your presentation, Andre. Now presenting on stage is Gary Blom, Executive Director at National Property Group.
Good afternoon, and Andre, thank you for the entree because you've led into what we're talking to you about. We're a property data company, and back in 2020, we acquired a property data company. Let's make sure this is working right. Back in 2020, we acquired a property data company that had been operating since 1987, but in New South Wales only, and they were a subsidiary of the Estate Agents Cooperative. And most of you, if you were around then, probably remember two products that they had. One was called Multilist, and the other was the Realtor magazine. Since that time, we've achieved a number of major milestones. We were then only in New South Wales. We've now moved into all the states and we're operating nationally. And that wasn't easy because we had to negotiate licenses with each of the state governments to get the VG data. And that's a very expensive exercise and a very time-consuming exercise. So today there's only 3 companies in the industry that have access to all the state VG data, CoreLogic being the major one, Domain, Pricefinder the second one, and ourselves. That in itself really creates a huge barrier to entry. The cost of actually getting that data from the state governments is substantial. The amount of probity that you have to go through with each of the state governments is extensive. The due diligence takes months and months, and the cost is very high. So, for example, our annual cost just to get the state data is $1.5 million a year. So that creates this real huge barrier to entry, and that's why there's only 3 companies today that are in the industry that are national, and we're one of those companies. We're both a SaaS business as well as a API business. Our SaaS business is where we are actually supplying a monthly subscription to a variety of different businesses. We currently have 2,000 subscribers, and that's growing, doubling every year. We expect to get to about 10,000 in the next 3 to 5 years. And then more recently, we've moved into the bulk data business, where we're now supplying bulk property data to enterprise and government. And fortunately, one of our competitors, and you could probably picture one it is, they have a monopoly on the government data business, and they've had that for a number of years. So the other company are not interested in that sector, whereas we're very interested. So our business will be twofold. Our major growth in dollars will come from our API bulk data business, but our churn will come from the SaaS business. We sell to a variety of different customers. We have real estate agents, property developers, mortgage brokers, banks, institutions, councils, etc. A very big range of different users that use our product. And this gives you an idea of some of the companies that we're working with. So we're working with valuers, working with real estate agents, property developers, and councils, etc. The market for property data is about $500 million in Australia. We are focused on Australia initially. We will be going into New Zealand before the end of the year, and with one of our partners we're moving into Singapore next year. But we believe there's a very big opportunity just to take some decent market share here in the Australian market. Our mission statement's pretty clear. It's that we want to provide relevant and timely data for all Australian business. So we're not just selling to real estate agents or property developers. Anyone who uses property data is a customer for us. So whether it's McDonald's or Woolworths or anyone like that, we have a very wide range of potential customers. There's a really good synergy here in what happened when Aldi tried to come into the Australian market. At that time, Woolworths and Coles dominated the supermarket business. And Aldi came in and said, well, how do we do it? And they said, well, we need to be the same but different. And if you've been to Aldi, you can buy a lawnmower at Aldi. You can buy things that you just can't buy at Woolworths or Coles. So we said, look, that's a really good synergy because we're coming into a market where there's a duopoly, being RP Data and being Pricefinder. How can we be different? What can we do that's different? So we said, yep, we can be the same, but we can be different. And the way we did that is we looked at the industry and we found that there was 425 companies that are in the PropTech industry. And they're all have a market share in some area. Now, most of these companies, some are big, some are small, but they all create data. Very few of them have monetized that data. So we said, let's sit in the middle of that, create a data lake, and let's enter into partnerships with many of those companies where we can get their data. That will generate revenue for us, but we can share revenue with them. And to give you one simple example, and we've entered into a lot of these agreements now, there's a company called Climate Valuations. Climate Valuations have a climate risk profile and a climate rating on every single property in Australia. They only sell to the banks. Their biggest customer is HSBC internationally. So all their revenue comes from the banks. So we went to them and we entered into a partnership with them where they now give us their data. We make that data available to our market and we in turn then give them revenue share on that. So as a result of that, we've now entered into other agreements like that. Our competitors don't do that. So we're offering something now that's very different where we want to sit in the middle of all these PropTech companies and be getting data from them and creating this huge data lake and then allowing whatever customer that wants to use it to have access to that particular data. So we're doing that for contamination and a whole variety of other things. In addition to our data sharing partnerships, we have 2 or 3 really key strategic partnerships. The first and most important one is a company called PropTech Group, who are a public company just been acquired by MRI. MRI is the world's largest property software company operating in many, many countries. And we have a partnership with them where they control 55% of all the CRMs for real estate agents. And so we actually developed with them a very deep integration into their CRM so that when an agent, for example, puts in an address, it automatically and seamlessly comes across, grabs all our data and brings it back into the CRM. So they have 55% of the market, and so we're working with them now to roll out into that particular market. The second strategic partnership, and for our friends at Homes, is a company called Homely. Homely is now number 3 in the portal space. Realestate.com is number 1. You have Domain number 2 and Homely is now number 3, and we're their official data partner. So we've also done an interface with them so that they get our data and we get all their listings. So we have about 85 to 90% of all the listings that are out there today. Our business, when we took the business over, the revenues were 700,000 in the first year. We went to 1.3 the second year. We're on track to do 3.8 this year, but we'll have substantial growth in years 4 and 5, or next year and the year after, because of our API data business. That's where the big upside for us is being able to sell bulk data, which we've now done with a number of parties, where we can sell bulk property data into the enterprise and government. And the government business alone is hundreds of millions of dollars. So with only one company that has a monopoly on that, we feel that we can take market share. Our business is a B2B business. As I said to you before, we're selling to agents, etc. So a year and a half ago, we decided that we needed to have a B2C solution. So we funded and we put $1.5 million into an app, which is called My Home Vault. Now, My Home Vault actually uses now AI, where you can take everything that happens in your house. Now, I'm sure all of you own a house or rent a house, and I'm sure you all have a bottom drawer full of all that crap to do with your house. Warranties, instruction manuals, paint types, etc., etc. So what My Home Vault is all about is digitising all of that information about your house. And we decided the only way to make it easy for you to load that data was to use AI. So using your phone, you can just walk around your house and it will pick up automatically that you've got a Westinghouse refrigerator, model number 777. It will then give you all of the instruction manuals. It will pick up all of your furniture, say you've got 2 tables, 5 chairs, whatever. Really important for home contents. So this is an app now that digitises everything that happens in your house, and then if you sell the house in the future, that particular app can transfer to the purchaser. Or if you're a landlord, you can give it to the tenant. So instead of the tenant ringing the agent wanting to know, what's the instruction manual for the pool or what the code is for this, My Home Vault does that. So we finished that product last year. It's been in beta since November, and we're going to market with that in the next couple of months. But that is a B2C product. And the reason we did that is that we wanted to get the consumer giving us their data. So if you bought a house 15 years ago, the only information in the public arena today is what your house was doing 15 years ago. So this way, if you can say, I've gone from 2 bedrooms to 3 bedrooms or 4 bathrooms to 2 bathrooms, whatever, you can update that app and we get that data. So we're actually accessing or getting access to the consumer eyeball through this particular app. So this is a great product, and you'll see a bit more about this soon. We have a very strong management team. So we have a new CEO starting with us in 3 weeks. He's currently the CEO of Century 21, and prior to that, he was the director of marketing for CoreLogic for Australia, New Zealand, and the UK. So obviously comes with CoreLogic background. Also from CoreLogic, Joe Rossi, who was there 25 years. Joe was head of sales and training for CoreLogic. Down the bottom, Chris, who's over here. Chris was also ex-CoreLogic. So we've gone and captured a couple of the key Logic guys. And Don Harb, who is our Chief Data Officer, has been with the company 21 years. Probably the longest person serving in the data business today, and obviously came with the acquisition when we bought it. So what's our 3 to 5 year plan? We really want to grow our revenue to between $20 and $30 million over the next 3 to 5 years. That will come by both organic growth, and the reason we're looking to do some capital raises is that we've got some opportunities to acquire some small data companies that will aggregate with our data. So we're looking to do some acquisitions as well. We really believe that once we have achieved that sort of number, then we would be a very good target for an acquisition. And the reason for that is that we're the only independent Australian company in the data business. Now, if you know of transactions in this particular sector, companies in what we're doing have been selling and been investing for somewhere between 8 and 10 times revenue. Some of them as high as 20. So we think once we get to $20 or $30 million, we'll have a business worth $200 or $300 million, and then we'll be a real good target for an acquisition.
Hi, Gary. I'm so sorry. We're on time. Can you make your closing statement?
Quick, closing statement, yes.
Thank you.
$4.6 million has been invested to date. Our pre-money valuation is $16.5 million, which is 4 times revenue, and we're looking to raise $3 to $5 million. Thank you. Sorry to take time.
All good. Thank you so much, Gary, for your presentation. Now we have Delvin Sela, founder of MPSS, coming on the stage.
Good afternoon, everybody. My name is Del Seller. I think it's a lot easier, as in the company Dell. I'm the founder of My Property Solutions in Sydney, and we're at the opposite end of the previous speaker. We're in the coalface. So, got that right? So we've been established for 15 years, in actual fact 18 years, and over the last couple of years I've been involved in restructuring our business so that we can scale it up for the future. So before we start, let's talk a little bit about the rental market. Over a third of Australians actually rent property, and that's becoming more and more popular, and it was about 27% back in the 70s, and it steadily grows each and every year. To rent a property is becoming extremely complex because local and state governments keep imposing legislative requirements, making it harder for landlords, in my opinion, and favouring tenants. And why this is good for us is that we believe it grows the market for people to want us to manage their property. The vast majority of rental supply is from private landlords, and that's simply mum and dads who go out and buy an investment property, and that becomes their way forward for building wealth into the future. Looking ahead, in fact, I think this is true of most of Australia, there's a chronic undersupply of property coming on the market, so we believe rents will continue to grow as time goes on. We decided to change the way real estate operates and created a new business model specifically for property management business. It takes into account the increasing legislative complexity, and that's important because we believe property management will become more and more a specialised activity. It gives us options to be able to rent property differently for our owners. That could be short-term rental, it could be traditional leasing, which is 6 to 12 months or longer, or it could be a combination of those two, and that tends to be property-specific and area-specific. Technology keeps advancing in our industry, making it possible for us to manage more and more properties with less and less fixed costs. We believe that this gives us opportunity to grow income streams for our property owners, as well as helping tenants become longer-term, consistent paying tenants. I want to talk to you about how we plan to scale up our business. I've got a background involved over 25 years in real estate, and through that course of time, I was involved in a lot of acquisitions. So quite simply, real estate agents frequently get out of business by selling their rent roll. That gives us an opportunity to pick up that income, add it to our existing flow of capital, and continue to grow our business. Now, the beauty of this process is that we don't pick up the rent and other fixed costs that go with those acquisitions, and they come into our network, they get computerised, and we simply do the hard work of managing their property going forward. So there's an opportunity to scale up. We've got 3 key members of the team, that's counting me. But I suppose the most important is our CEO, Arisi Doolan, who's been with our business literally from its inception, knows all of our clients, and runs our office structure. She's supported by Anela Falvo, who goes out into the field each and every day and looks for opportunities to grow our income. This includes selling property, where we have an option to turn around and sell that property for our owner while retaining income from that owner through rent collection and effectively selling the property with the tenant in situ, which allows that income to continue to the new purchaser if they so choose. We believe that's substantially different to the traditional transactional base that takes place in property sales. We want to work with investors to scale up our business. I think most of you understand the benefits of scale. Acquiring rent rolls is an optimum way of doing that because you just acquire the income. Occasionally you will have to add a new member of staff because there is a limit to how many properties an individual can manage, and we've developed a formula to keep that process rolling on. There are some legacy challenges in our business. The traditional one has been that to grow market share, you tended to go out and acquire new offices. We believe that that process for us is centralised. We'll only have one office, but we actually manage properties all throughout Sydney, from the west all the way to the city and around Manly and the Northern Beaches, which is the main area that we operate from. As an important thing for investors to recognise, we have an existing income that covers our fixed expenses. So we're looking for capital to actually grow that income and improve the business into the future. So our offer to investors is very straightforward. We're looking to raise $2 million worth of capital. We're doing that via the issue of a preference share, which means that you, the investor, get a steady 7% per annum return payable each month. And you get that return from our regular rent collections. At the end of 2 years, your preference share matures and you're able to exit with your capital, or alternatively, through another arm of our business, you're able to convert that capital into an apartment at a fixed wholesale price through our property rights. Now, obviously, there's some conditions to that, but time's going to beat me to go through all of those. We're not talking about an ordinary apartment. This is an apartment within a development that will contain a 5-star hotel and a number of other lifestyle improvements, including a family restaurant, alfresco dining, etc., plus a neighbourhood supermarket. So it'll become a community within itself, and it will have outstanding views, space and light. That's a typical apartment that investors may convert to. All right, over 130 square metres in size, self-contained, ideally able to be rented at a consistent 5 to 6% return. So in overview, you can invest through MPSS, get a consistent 7% monthly return, a suck it and see exercise. You might like us, you might love us, and you might say, I love you that much, I'm happy to go through and convert into an apartment. That apartment is at a fixed $400,000 price plus GST. That means that you retain all capital gain in that asset that's been acquired in that time and into the future. I think it's an offer that's a little different. I hope you agree with me. Look forward to discussing with you at our stand 8. Many thanks for your time, and I've managed to do this with 30 seconds left to go. Thank you.
Amazing. Thank you so much, Delvin, for your presentation. Our next speaker is Colby Phillips, Manager Investor Relations of Arcana Capital.
Good afternoon. How are we doing? Bit of a whirlwind couple of days. Obviously, with all these great companies doing awesome things, it's great to be here and I guess see what's going on in these different technological spaces. I suppose we have a slightly different offering to the exciting tech startups that we've seen across the last couple of days. We're a property fund. We're pretty meat and veg. We're very straightforward, and I suppose I'll take you through our offering now. So, Arcana Capital. Our big thing is making things easy and making things transparent. So, as you can see, we're looking to provide structure, we're looking to provide compliance and opportunities for investors to kind of potentially establish their own commercial property portfolio without having to go all in and buying their own property, and then likewise, maybe doing more competitive returns, etc., than some of the bigger funds. Now, the way that I think of it is that there's kind of a spectrum between transparency and hassle, and I suppose it sort of ranges from being a property owner yourself, a commercial owner, where you've got to pipeline your own deal, you've got to do your own due diligence, you own the property, at which point you've got a huge chunk of capital sunk into that one property that you're managing and owning. And I suppose reduces the opportunity to diversify. And then the other end of the scale might be one of these larger funds that has open-ended trusts where you can just tip money into and just watch it roll through. I suppose we try and offer a middle ground to that, in that A lot of our investors like having the control to be able to pick and choose exactly what they're investing into, but also know that it's hassle-free because we're running the show, we're managing it, and we're kind of looking after their capital for them in a single asset basis. So our offerings, they range. So they're mostly single asset unit trusts, some multi-asset unit trusts, but they're all closed-ended. So we're not sort of tipping properties in and out of funds. It's a variety of asset classes based on what our investors' appetite is at any given time. So, for example, we just did a sort of a large capital city office transaction, and I think that probably has tapped out our investors' current desire for office exposure. So we might stay away from that for the time being, or we might receive information otherwise. As you can see in the pictures, we've done fuel, we've done large industrial centres, we've done large format retail, all the way through to strip malls, etc. So we do quite a bit of range. And the way they're set up is that they're special purpose vehicles. So it's a unit trust with a trustee company, and by investing, you're purchasing units in that trust. So you're a unit holder, effectively a shareholder. You have rights associated with that. So since 2015, we've acquired over $212 million in property and currently manage over $110 million in investor equity at point of purchase. Across the portfolio, we're returning about 8.3%-ish in distributions, and they're paid monthly. So very much an income stream play for a lot of people. Our view is that really our focus is to protect capital and provide income, and if we can exit with a capital gain, that's a bonus. But otherwise, our priorities are really protection. So, on that rate, we're paying over $9 million in distributions per annum right now. So, a bit of a mission this slide, but effectively what we're trying to do is show exactly what's going on prior to a commitment by an investor. So we're constantly shaking the trees and turning over rocks to find the next deal, and we're assessing them, doing sort of fairly extensive due diligence, getting them under contract, establishing documentations, information memorandums, etc., and then we start the capital raise with investors. So they come in basically right at the end of the process and then buy into the trust. It settles and just start receiving monthly distributions. We say that you can be as involved as you like. So some investors are fairly passive in their engagement, which is fine. So they just watch the distributions roll in. Some investors are very active and they're almost like assistant property managers. They'll check out, they'll report, they attend our AGMs, etc., etc. So, a bit of a mix, and I suppose the idea is to make it available for everyone to pick and choose how they want to operate as investors. So this is the most recent thing that we've done. It was our largest thing to date. So that was 2 commercial office buildings, one in Brisbane, one in Perth, at a total purchase price of $25 million. So we raised just under $16 million for this one, and it's paying a 7.25% per annum distribution forecast. So I suppose this one's in there because it kind of establishes a type of risk profile. So they're capital city assets, they're fully leased, I suppose in somewhat safe territory, and paying a distribution accordingly. We do play with different risk profiles as well. It just depends on where we can find value. So for example, the next one, which was actually the one we did just before the Capital City Trust, the 18 South Logistics Unit Trust. Smaller purchase, regional, very regional, in fact, it's far north Queensland. But we had a look at the opportunity and assessed it at its merits and dusted it off and did some engineering on the deal and decided that it was an optimum risk profile for us, that we were happy with it, we could get good terms. So we proceeded with it, we settled, and it's now paying a 10% distribution per annum to investors. I suppose that exemplifies the range of stuff that we tend to do. It's never developments at this point. We just buy existing properties, existing leases. We want to provide just a solid source of capital protection and income. So that's that one. These are our directors. Might be a familiar face or two up there. We've got Peter Eccleston in directing investor relations. He's got extensive experience in the commodities market. Campbell Newman, he started up Arcana alongside his friend, the late Dom Condon, in 2015. And Christina is our CFO, and she's got extensive experience as a CFO for property funds over the last 2 decades. So we're very blessed to have this team on board, and they're very hands-on steering the show. Now, I suppose one key thing that really gets people over the line for us is that we're not a churn and burn fund. We're not strictly held to, say, a 5-year hold period and then we just get rid of the asset because we want to collect fees along the way. It's actually up to a vote of unit holders at the end of the holding period. So, some assets we might hold for longer than 5 years because it just doesn't make sense to dispose of it, and the unit holders vote accordingly. Furthermore, the directors have skin in the game. So every single thing that we acquire, the directors invest in as well because they back it and they see that it's a good asset, and then they perform accordingly, incentivised as investors and directors. So it's a great team. So our ask at the moment, if I'm being completely honest, is we just want people to talk to. We just finished our last capital raise, 15.8 mil, and don't have any opportunities right now, but we tend to do between 4 and 6 a year. So we're really just assessing interest, to send an email out to or jump on the phone to for our next thing. If there's any interest there, you can see our website, our LinkedIn, etc. And of course, feel free to come have a chat afterwards as well.
Thank you so much for your presentation, Colby. Our next presenter is Arthur Normandes, CEO of Aligned Disability Investments.
Okay, hi, thank you. And I'll start with ticker. Firstly, I'm going to start with a disclaimer for you to read later on, so I'll move on quickly from that. We're a fund, general advice. There shouldn't be any retail investors here, but just in case, there's no personal advice. I'll start off with a little background. We're a property fund specialising in the NDIS space, in the delivery of specialist disability accommodation. So firstly, I think most of us have heard about it, but NDIS delivers around about 550,000 Australians, services to 550,000 Australians. It's forecast to grow by the government to about 741,000 over the next 4 or 5 years. So it's growing. It's another 189,000 people being supported. So specialist disability accommodation, which is what we're focusing on, is a range of housing that's designed with people with extreme physical needs. And you'll see why later we're focusing on that. And it's poised to grow. So just as NDIS is poised to grow, the SDA component is poised to grow over the next few years. And we're going to add about 2,500 dwellings. And so it's a market that I think we're in the early to mid stages with. So there's a fair amount of growth to come. Now, the key objectives of the fund is to develop a portfolio of SDA properties. Obviously, there is a social outcome, which is to deliver, improve the lives of the disabled by providing them with housing. You may not be aware, a lot of the disabled people at the moment, the younger ones, 30, 40-year-olds, 25-year-olds, they live in either hospital, because they're quadriplegics, or they live in aged care homes. And people say, well, why does the government pay investors to build accommodation, to pay this high rent? And the reason why, it's cheaper for the government to put them up in private accommodation than it is to put them up in hospitals or aged care. Not only is it cheaper, it's far better for the participant as well. From an investor perspective, clearly, a lot of investors say, oh, I want to do good, but the reality is they need to make money as well. So you'll see with our offering, the investors make an attractive ongoing income. And you'll see that one of our key strategies here is to not just simply buy and hold, it's to buy, hold, build a portfolio of properties and sell them. Why? You'll see in a sec, but when you sell them, to recycle the capital and do it again. So as an investor, instead of building one NDIS in Dubbo and getting 12% yield for 10 years and then selling the property, here we do this, and every 3 years we hope to recycle the capital. And at the same time, hopefully the investors make some capital uplift on the sale. And so that's the high level. Now, the key opportunity that triggered the creation of the ADI fund is what we call pricing asymmetry. At the moment, people build NDIS properties, and most of the construction's going on in regional country, regional Victoria, regional New South Wales, not metropolitan. And the reason is the same rent is paid by the government regardless of where you live. So investors, therefore, are building in places where the land is cheaper. But what the objective here is that when you deliver, in my last business, we built about $50 million worth of NDIS, but all individual homes being owned by investors. Now, the yield is about 12%. That's the Goldilocks range. And in regional Victoria, regional New South Wales, you'll achieve that when it's fully rented. And that's great. But what you find is that institutional investors, if we can build a portfolio of these, say 50, 60, 70 properties in one go, yielding 12%, we package them with a nice little bow and sell them to an institutional fund, sell them to an industry fund. When they buy a Bunnings or any other commercial real estate, they buy at what's called a cap rate. The cap rate is the income divided by the purchase price. And the normal cap rate at the moment is 5, 6, 7%. Now, so we're working on between 8 and 10 that we can sell. So if we've got something spinning 12 and we're selling it for 8 or 9 or 10, that's a significant capital uplift. Why would the institution do that? Because they can't be bothered building it themselves. They want one transaction that, as the previous presenter said, they want something already built, something already leased, delivering income. That's the objective of the fund, and that's the opportunity, is to build and acquire this portfolio of properties. And so what we're doing there is also use debt, conservatively. Our LVR is about 45%, which is, I think you'll agree, a very conservative loan-to-value ratio. Is an example. One of the things that we've done is that, as I said, the same rent is being charged in Dubbo versus Vaucluse. What does that mean from an investor? Can you build an NDIS property in Vaucluse? The answer is no, because the land is 4 million or 3 million. So we're only targeting metropolitan Melbourne and Sydney. And how do we solve this problem? Is we do a hybrid resi NDIS development. So this is a good example. Basement car park, ground level is NDIS, level 1, 2, 3 are residential properties, the top being a penthouse. We sell level 1, 2, 3 as a normal residential. Level 1, 2, 3 gets allocated 90% of the land cost. That delivers the ground floor as an NDIS with a land cost very similar to what you'd get in regional New South Wales and Victoria, which means we can deliver the Goldilocks 12% yield. So it's a very, very simple structure. And what we do is we sell, so I'll go back a bit, we sell the properties and we expect to get some development profit. That's distributed to investors. The capital is returned and then recycled, we do it again. Meanwhile, we keep the 4 NDIS properties. They stay within the NDIS fund, the ADI fund, and we build them up. So we keep doing this again and again until we get sufficiently sized number of properties that we can sell them in one line, and then we do it again. So it's a very simple strategy. The thing is, why don't Mirvac or any other people do it? And the reason why they don't is that it's too bitty. Government doesn't allow a big development of NDIS. It's about 4 to 6 maximum in any one development, which means it's what's called salt and pepper. It's all over the place. A Mirvac doesn't want to do that, wants to build a whole bunch of the same design. So it doesn't suit the big guys. The small teams are a single accountant creating a syndicate. And that syndicate, to build something like this, is 15, 16, 17 million. So that's why they don't. We have a lot of risk management techniques in terms of SDA selection, making sure that there's tenants. But guess where all the tenants live, the NDIS participants? Metropolitan Melbourne and Sydney. We're not building in regional areas because we believe that there's saturation risk and vacancy risk there. We're building where most people don't build. So there's a whole lot of compliance. I've got a minute left. So we've got launch partners. So obviously ourselves, we're financial services background. I'm a platform specialist. My partners run what's called a SMA managed fund. They've got about 400 million under management and they're seeding the fund. So basically we're a fund. We've got enough capital for that first $20 million worth of transactions. So over the next year or two, you'll hear more about us. And so the objective today is just to introduce ourselves, and at some point in time, you may get an opportunity to invest. So thank you very much.
Brilliant. Thank you so much for your presentation, Arthur. We now have a presentation by Bob Anderson, Managing Director at Longyard Capital.
Thank you to all the wholesale investors currently watching. My name is Bob Anderson. My intention is to keep this presentation to 7 minutes, and the structure of the presentation will be, first of all, an introduction to Longyard Capital, the investment offer, the security underpinning the investment, who is Bob Anderson, and what makes this investment unique. Longyard Capital itself, it was established to raise funds for the development of an over 50s retirement resort on a Greg Norman designed golf course. Longyard Capital loans funds to the development and holds a registered first mortgage as security. Longyard Capital offers redeemable preference shares to investors, offering fixed dividends paid quarterly. So the investment itself, shares are $1 each with a minimum investment of $100,000 and thereafter in tranches of $50,000. Dividends are paid quarterly, the equivalent of 9% per annum interest. The term is 24 months. The security, as I mentioned, is a registered first mortgage over the land and all improvements. And look, it's ideal for cash on deposit, lines of credit, self-managed super funds. And there is no direct involvement between Longyard Capital and the development. It simply loans funds to the developer for the development. So what underpins this development? I'll tell you more about it. Well, firstly, population projections. This is for the over 65-year-olds. Back in 2007, about 2.8 million people. Have a look at the graph there. The top one's the one we're interested in, is the over 65s. By 2057, it will be over 8 million. Rapid growth in the over 65s. What's that mean? Well, in 1970, there was just 1 million people over 65. By 1995, 2.1 million. By 2020, a couple of years ago now, 4.2 million. 2066, 9.5. You can see the growth there on the right on the percentages. So what can you tell from that? Well, there's a huge growth within that over 65 market, and the over 65s need appropriate accommodation. Speaking of appropriate accommodation, what I'd like to talk to you about today is Majestic Tamworth. Majestic Tamworth is, as I mentioned, it's a retirement village on a Greg Norman designed golf course. As you can see there, those green areas, they're the fairways of the golf course in Tamworth. It's the Longyard Golf Course. We bought part of the golf course to develop this retirement village. The village itself has 99 homes on the Longyard Golf Course. It's developed over 5 stages. Project value is $53 million, and it's just 100 metres from the golf course, and it has its own large community building as well. That's a bit of a site plan of it. As you can see, lots of green areas, a couple of lakes involved as well. So, Majestic Tamworth. Why Tamworth? Well, quite simply, demographics. Demographics drive retirement villages. As I showed you, it's the over 65s. In fact, in this case, it's more to do with the over 50s because this is an over 50s lifestyle village. Exceptional demographics in Tamworth. Population 67,000, of which 49% are over 50. Our target market is over 50. That means our target market is 33,000 people. And there is no direct competition for this particular type of retirement village. So, the project, where's it up to? Well, the sites have been purchased. We've obtained a development permit. We've obtained the construction certificate. Australia's top marketing company, One Fell Swoop, is installed. We have a display office already well operating. We've appointed a builder. In fact, the houses are currently under construction. The houses are built off-site. We have a large factory where we build the houses, and then they're transported 5 kilometres to site. Civil construction of stage 1 has already commenced. In fact, it's nearing completion. And we have deposits paid and contracts signed. So this project is not a startup. It is well and truly underway. Look there at some of the housing. Good quality, low-set housing, 2 bedrooms and 3 bedroom houses. Very well fitted out. That's the clubhouse, or will be the clubhouse as well. It's sitting on the lake. So, myself, Bob Anderson, who am I? Well, I am the Managing Director of Longyard Capital. I'm also the developer of this particular project. 39 years of property development experience and 30 years in retirement development. I've developed 9 retirement villages in my career, and I've been the state and national manager of 2 of the largest property development companies in Australia. I've developed over $1.3 billion worth of projects and over $300 million worth of joint ventures and capital raisings. pushing along. That's the front view of the community building, and that is the rear view of the community building on the lake. Okay, so what makes this project unique? Well, it's the age demographic. As I said, nearly 30,000 people, that's our target market, over 50s in Tamworth. There's no comparable development either underway or proposed. It's situated on a Greg Norman designed golf course, the Longyard golf course, and price points are $479,000 for the 2-bedroom and $540,000 for the 3-bedroom. There have been up to sales of up to $2 million of houses that front the golf course. Okay, so that's the project, but what about the investment? What makes this unique? Well, first of all, a highly experienced developer. That's really important, and registered first mortgage security. Longyard Capital technically is the bank, and so you are an owner of the bank when you invest in Longyard Capital. There's no direct project risk. The funds are lent on to the developer, and the project is well underway. It is not a startup. So just a bit of a recap on the investment itself. As I said, shares $1 each, minimum investment $100,000, thereafter $50,000 tranches. Security, registered first mortgage over the land and all improvements. Dividends paid quarterly, and they're equivalent of 9% per annum. It's ideal for cash on deposit, lines of credit and self-managed super fund, and the term 24 months. Longyard Capital, there you are. If you'd like to know more, I suggest you scan the QR code on table 19, and we'll be only too happy to discuss the offer with you. Thank you for your time. Talk to you soon.
Brilliant. That was a great presentation by Bob. Now we have a presentation by Dr. Tony Sassy, founder of Snoretox.
Thank you very much. From a real estate development to a drug project, sort of an interesting jump. We are Snoretox Proprietary Limited. We have developed the world's first muscle toning drug. It's based on tetanus toxin, which is first cousin of Botox. Botox reduces muscle tone, so when you inject it into your wrinkles, the muscles relax. Our product will increase muscle tone, and that's how it works. It's otherwise very similar. You inject it, very small needles, and it lasts somewhere between 4 and 6 months. So we ran it in our bulldog model. Bulldogs have short snouts and they have trouble breathing. So let's have a look at the video of the bulldogs, please.
The problem with the bulldogs is that they've been bred for a certain look. That look is a very short snout, and that has consequences to the back of the throat and the way air passes down the larynx, and makes it difficult for them to breathe. The improvement is dramatic. The noise has gone, or the respiratory noise has gone from sounding like the inside of a washing machine to essentially silent. Two of the dogs, Luna and Storm, have tremendous improvement, and you can't hear respiratory noise unless you get up close to them. And 5 months ago, that was sounding like the inside of a washing machine. The improvement for the dogs is certainly life-changing. They've gone from respiratory discomfort, consistent, constant respiratory discomfort, to breathing essentially normally.
We also tried it out in motor neuron affected mice. So that's ALS in American, of course. And it's a little test where they have to hang on for as long as they can. And our drug increased their muscle tone and performance very nicely. So our first target market is the veterinarian health market. There are over 5 million bulldog type dogs in the world, and we have FDA breakthrough status for this indication. It's called BOAS syndrome, brachycephalic obstructive airways syndrome. We believe that we will be able to sell in about 3 years' time into this market, once we've done a few more trials for the FDA, and we anticipate sales of over $100 million per annum. It's a very cheap product to make, only $5 a dose, and we plan to sell it for a lot more than that. The unmet need in humans will take longer, 5 to 7 years to FDA registration in humans. We're close to first in humans now, just 6 to 9 months away. We have a few safety studies to do. The indications in humans are any low-toe muscle disorder. So I'm a sleep physician and I invented it for sleep apnea because there are no drugs for sleep apnea yet. But we don't plan to replace CPAP, but we just plan to help those who can't use CPAP, which is half of them. Urinary, fecal incontinence, pelvic floor weakness, motor neurone disease, of course. Ectropion is a floppy eyelid condition that old people get, and your eyelid sort of goes down. And we think it'll work nicely in that. And also recovery of muscles after injury. The technology is one of increasing muscle tone, and it does that by entering the nerve, going up and changing the internal working so you get increased neural output. Botox does the opposite. We had to solve the vaccination issue because we're all vaccinated against this molecule. That's called the tetanus vaccination. So we do that by using an antibody trap. We include a non-toxic decoy molecule that absorbs any local antibodies. It only needs to be there for 24 hours. During that time, the real molecule gets into the nerve and does its job. So here's a demonstration in 2 very highly vaccinated mice. Each of these mice have had 3 doses of vaccine. And the mouse on the left just had tetanus toxin without our additional decoy molecule, and nothing worked. The 2 legs are still flaccid. But the one on the right, the molecule gets in, makes the leg go tonic, and so it works very nicely in the vaccinated population. Sleep apnea has had no new effective treatment really for 30 years, certainly no drugs. There is a phase 2 trial just completed in a different class of drug in sleep apnea that might be very useful, but it might have a lot of side effect problems, so time will tell on that one. Sleep apnea itself is very common. Almost 1 billion of us have got it. And if I look around this room, I'm sure we'd find a few people here who'd have it too. We surveyed key opinion leaders, the world's best opinion leaders in sleep apnea, and 92% said there was a need for new treatments and 33% said a desperate need. So there is a need for our product. As I mentioned earlier, 50% of patients who use CPAP either can't use it or don't like it. So we have a sizable market of non-CPAP users of around 200 million that we're aiming for. The key opinion leaders thought 38% of patients would use our drug at some point, which I found as a sleep physician myself, that's a little high, but that's what they said. Some of the feedback that we got from the leaders was impressive. It was quite pleasant to read, actually. I like the one that said it'd be a phenomenal breakthrough. We spent 20 years working on this, so it's nice to have some peer review that's good. Does it work in sleep apnea in bulldogs? Here's our trial in our first bulldog. The sleep apnea score fell very nicely with just a localised injection. For human patients, the dose will be administered with a tiny needle, what's called a 34 gauge needle, which is about the same size as a mosquito needle. It's a very small needle. ENT surgeons and dentists will administer it in sleep apnea, and in other indications, trained doctors or nurses will be able to administer it. We think it has very large human potential in a whole range of conditions that I've mentioned earlier, so I apologise for the busy slide and I'll skip it. But we are aiming over all the various market sectors: sleep apnea, ectropion, incontinence, pelvic floor, motor neurone disease, injuries and dogs. We think we might get up to 18 or 20 million patients when we're fully rolled out per annum. The intellectual property is being managed by Griffith Hack in Melbourne, which is a part of IPH Global.
and we're in good position there. We only use quality partners for all the various regulatory and technical development we've had to do. We've spent almost $4 million Australian to date, half of which has come from grants and half of which has come from small investors. Our manufacturing protocol is complete. As I said, we can make it for $5 a dose. We did win FDA breakthrough status for dogs, which is great. We also won the MRFF Frontier Fund Round 1 grant, which is a highly competitive, prestigious grant in Australia, and a Department of Defence MTech grant last year in the United States. We're a spin-out from RMIT University. We have a board of probably a bit big, but very experienced, 3 experienced pharmaceutical executives, a full-time scientist, a business head, and me. Our scientific advisory committee is probably one of the best you'll ever see in Australia. The professors along the top row are just an amazing bunch. Pick out John Funder and James Angus. James will probably be the next Governor of Victoria. As I said, our first in humans in 6 to 9 months, and we think around 3 years to get veterinary approval and start commence sales into the veterinary market. We have 2 asks. Basically, we are being looked at under due diligence circumstances with a VC in America at the moment, considering a pre-commitment of IPO funding. That will be up to $25 million US. If that gets signed off, then we only need 3.5 million between now and the float in around 18 months. We also have a convertible note offer from our manufacturer's parent called Wholesale Ventures in San Diego to cover the manufacturing cost, which is quite a lot, as you would imagine in a GMP standard drug. So assuming both those pre-offers continue, then we're basically just looking for around $3.5 to $4 million at this point to get us to the IPO. The complete project to get to sales in the veterinary market is around $10 million Australian. If anybody wants to take that, we'll be happy to do it. So our investment highlights is basically a world-first drug with a big market. And thank you for your time.
Amazing. Thank you so much for your presentation, Tony. Our next session promises to be an informative and engaging one. Just give us 1 minute to get through the setup. Thank you. Okay, so like I promised, our next session is going to be a very engaging one. So we have the pleasure of engaging in a very thought-provoking conversation with Peter Mobbs, Managing Partner of 5 Sigma Growth Fund. 5 Sigma is a global growth fund with a focus on edtech investments, and Peter has had an extensive career in finance and has been with 5 Sigma since its inception. He's an expert in the field of edtech investing, and he's helped to lead 5 Sigma to become one of the most successful edtech funds in the world. I'm excited to actually pick your brain on the current state and future of edtech investments. So please join me in welcoming Peter for this session. Thank you. So Peter, to begin with, can you tell us a little bit about your journey and experience in EdTech, and then we can delve into the topic of sector investing?
Sure. Thanks for having me. It's good to see you again. So I started my career as a lawyer, and I was one of the lucky few to escape, and I kind of fell into education. It was completely by accident, but it was fortuitous because I started a business and it took a little bit of time to get going, but then it went quite well. And we sold that business back in 2006 to an American company called Kaplan. And I then did a couple of other things working for other international education businesses, and then started another business, and that went even better. And we sold the majority stake in that business to an Australian-based private equity fund, and then just bought that business back off private equity about 6 months ago. So so I've kind of been in education for about just over 20 years now, and then I started investing my own balance sheet, and I was investing into things that I understood, namely education technology, and that went really well. We had an incredible return, about 10.1 times return on invested capital, which is a lot higher than most funds. And most of that's realised as well. It's not paper money; it's actual money that's come back. And then we decided to sort of parlay that into a fund to allow other people to invest in the fund and to continue to invest in edtech.
Amazing. Thank you for that introduction. It's actually great to meet someone from your experience who's leading both, as a founder and also an investor. So this is what I want to touch on, that, you have had quite an interesting journey. So from being a 2 times exited founder to a Series D lead investor. So can you share with our audience as well a little bit about your personal story?
So we were able to, as I said, parlay from selling our business into investing our own balance sheet into investing now via the fund. But I found that it was a lot easier to stay super focused on the things that I really understood, namely education technology. Every time I detoured out of that, I got burnt, and so that was a good reminder to stay focused on what you really know. And so I then started the fund, and I was thinking about the different investments that we would make and where we would focus. And it made sense for a number of reasons to focus on the later stages of education technology. So education technology is a pretty broad concept, and despite us being narrowly focused, it's a huge market. So to put that into context, the global education industry is $6 trillion. Getting closer to 7 trillion. The education technology market is 220 billion, on track for 404 billion by 2025. So it's not like we're playing in a small pond. We're very narrowly focused, but we're playing in a really big pond. But we decided to stay focused on the later stages of EdTech, as in Series C and D for us, because it's much, much lower risk. So they're mature businesses. They've been around for a while. They've got a track record. They've got significant revenue. So that's number one. Number two, the path for us and our investors to get their money back is much shorter. If you're investing early stage, sort of seed stage, you've got to be willing to be in that business for 12, 14 years. Whereas when we invest in Series C and D, we can be getting our money back. We can be in and out in sort of 3 to 5 years. So it's a much more truncated path to liquidity. So that's what we did. That was our experience, and that's why we decided to focus late stage. But in answer to your question about how we ended up then leading Series D rounds, we invested in a business recently called Go1. Go1, based in Brisbane. It's a $2 billion business, over 100 million in annual recurring revenue. But I've known the founder of that business for maybe 6 years now. In fact, we talked years ago when I was operating my own business about partnering with Go1 for content, and for various reasons we didn't end up partnering, but we just stayed in touch. And so I then had a personal investment in Go1, and so I knew that it was a really good quality business. I trusted the founding team. I think they're one of Australia's best founding teams, actually, and I knew the industry, obviously. So we, I guess, had this inside understanding of the business, And when they were looking to raise their Series D, and we happened to have a fund focused on Series C and D, I obviously tapped my network and said, Andrew, we're keen to lead this round. So it was a great one to lead. The co-investors there that could have led it are names that you would most likely know. So SoftBank, Madrona, Microsoft's M12, Salesforce Ventures, so super big names, but we were delighted to lead that round.
Brilliant. It's so inspiring to hear from your journey. And I think as someone who's just starting a career, there's a learning here that, you have to take that risk and you never know where a decision leads you. So like you took so many, risks at your journey and you had that trust in the founding team. I've always heard from different startups that I work with, there's always the team, which is very important. So it's good to know from your experience that we saw that firsthand. Now, you've touched on Go1. And it's one of your portfolio companies, like you said, and you led their $100 million Series D round, which is followed by VCs, like you mentioned, like Salesforce, Airtree, SoftBank. So can you actually walk us through those investment notes?
Sure. So when you're investing late stage, there is a lot more that you can diligence. If you're investing early stage in seed rounds, the businesses haven't been around for that long, so there's just less that you can check on. Whereas Series D businesses like a Go1, they've been around for a long time, significant revenue, lots of contracts. So there's all sorts of things that you can diligence. So our approach is more like a private equity fund than it is a VC fund. So seed stage VC funds don't do that much diligence, not because they don't want to, there's just nothing to diligence. Whereas we approach it more like we're buying the entire business. Clearly we're not, we're taking a very small stake. But we do deep legal DD, financial DD, tax DD. We engage the biggest firms, PwC, King & Wood Mallisons. So we approach it really, really seriously. In the back of our mind, remembering it's not all our money, it's other people's money that we're investing. So you've kind of got to take it seriously. So that's the approach that we took. In terms of the notes, there is so much to like about Go1 and so much to talk about. I'll try not to bore you with the details, and obviously there are some things that Go1 wouldn't want me saying about their performance, but they're circa that 100 million in ARR. They've got really high gross margins, so they're sort of 75% plus gross margins. It's off the charts. They're also growing at around about 100% year on year. So, VCs will generally want to see around sort of 30 or 40% year-on-year growth, or preferably higher, but that's a sort of starting point. But as the businesses get more and more mature, that sort of 100 million mark, you just don't expect to continue to get 100% year-on-year growth. But Go1 is that type of business where they're getting that sort of growth. They also had like a 6 lifetime value to CAC, the lifetime value of their customer compared to the cost of acquisition of a customer was 6, which is really, really high. So many of the metrics made sense. It was in our sweet spot, and we loved the founding team. So it was, I wouldn't call it a no-brainer, but it was the perfect investment for us.
Brilliant. That's amazing. Now, for my next question, I would love to know, because this is for the investors in the audience. So can you tell us your thoughts on why and how should they consider investing in a sector fund? And first, actually, let us start with talking about sector-specific investment. So if you could share like what value actually someone gets when, they focus on specializing on a particular sector.
So I touched on it earlier today that when you are a generalist, you can only go so deep into understanding an investment that you make. So, a lot of the generalist VCs, this is not a criticism, but today they do an ed tech deal, tomorrow they do a space tech deal, the next day they do a health tech deal. So you can never be really, really deep in your understanding of any one area because you've got to become an expert on something else the next day. But what we do is just go really, really deep into this narrow field of edtech. So the advantage to us is that we can identify risk factors better than a generalist. We can pick winners better than a generalist. And so that's what we're trying to capitalise, is that the knowledge advantage that we have over a generalist. The advantage to the investee company is also that we tend to know a little bit more about what we're talking about. So even though we might not be writing the biggest check, SoftBank writes $100 million checks. That's generally their starting point. We're not writing $100 million checks, but we've probably got as much or more influence on the businesses that we invest in, just because we understand the businesses so well. And I've been an operator, so I can sort of commiserate and support the founders in a different way to a generalist that writes a big check.
Absolutely. And Peter, these are great points to keep in mind when someone talks about sector-specific investing. So something that I touched upon, which now for our audience it would make more sense, was why and how should they actually consider investing in a sector fund? And if you could actually talk to us about what percentage of their capital that they should invest as well. Any tips you could share?
So the number one takeout, I would say, for today's session is that sector-specific funds perform better. So if you have a limited amount of capital that you want to invest, you should absolutely be thinking about investing in sector-specific funds. And this is not just me making up a statistic. Cambridge Associates are a research firm. You can Google this, Cambridge Associates sector-specific funds, and you'll see a longitudinal study that they did that showed sector-specific funds perform better by a margin of around about 3% IRR. So sector-specific funds, I think it was 22% IRR versus 19% on average for a generalist fund. That's a lot of money over a long period of time. So the data shows that, but if you think about it intuitively, it makes sense, because you're investing in a fund where the manager just knows that so well. So they've got this obvious information advantage. So from an investor perspective, I would encourage people to think about investing in sector-specific funds. In terms of how much you would allocate, it's a tough one, and obviously it's not financial advice, and you've got to think about what makes sense for your own portfolio. But often what investors will do is say, I would like, say, 10% of my portfolio to be allocated to alternates. So private equity, venture capital, etc. For us, for me personally, I allocate about 50% of my portfolio to alternates, because it's a space that I really know, it's a space that I like. I know I'm going to get better returns. I might not have liquidity like if I was investing on the stock exchange, but I get a better return in return. So I invest a higher proportion of my portfolio, and you have to think about what makes sense for you. But within that percentage that you allocate to alts, you then got to think about, do I want it all to go to generalists, or do I want to have it all specialists, or somewhere in between? There's no right answer. Just don't miss out on investing with specialists if you know that they're going to get a better return. And clearly you have to diligence the managers as well. You need to know, does this manager really know what they're talking about? If you're talking to a manager who's a specialist in Web3, and there's lots out there, Web3's only been around since 2014. So there's only so deep you can go in a, 8-year history. So I'm not saying don't invest in Web3 fund managers. I'm just saying one of the things you can do as an investor is diligence the investor and make sure that they've got deep sector experience.
Yeah, absolutely. I completely agree with that. And thank you for that explanation. Now, see, you've led both lives as, a founder and also as an investor. So it would be great to hear your thoughts, and how do founder and investor perspective actually differ when we talk about, investment decisions? Any thoughts you could share on that?
So sorry, was that the investors or the founders, or both?
As both founders and investors, how would their thoughts
from
differ?
a founder perspective, the founders want a few things. One of them is credibility. Yes. And so if they have a bunch of generalists that have invested, they're on their cap table, that's great. Particularly the bigger the name, the better. So if you've got Sequoia on your cap table, that's great. It's a stamp of approval. If you've got all of the big names, that's even better. But there's always a question mark if they're investing in a niche sector. Do they really know what they're talking about? They're big names, they've got big checks that they can write, but do they really know what they're talking about? So when a sector-specific fund comes along and then backs a company late stage that these other big names have already invested in, that's the ultimate stamp of approval, because it's sort of saying, well, the generalist said it was good, but now the sector-specific funds have come in and said, we really like this one. We think this one's the best of the best. So it's credibility for the founders. It's also a sounding board because they get more support. They get people with deeper knowledge. So I think they're the benefits for the founders. I think for investors, you ultimately want to get the best return on your investment. The problem is it's easy to get distracted with what's sexy, and it's, as a result, easy to lose money. So one of the things that we offer is really unsexy investments. There are much sexier things out there than EdTech, but it's one of those things that's growing really fast. It's a huge market. It's counter-cyclical. It's almost recession-proof because governments are always supporting education. So we offer something that's unsexy, but likely to give you a better return. So which one are you going to take?
Amazing. Perfect. So thank you so much for sharing your thoughts on that. Now, as a parting question, I would love to ask you let's talk about the discerning opportunities in the EdTech sector. So can you share some insights on how do you do that?
So it's kind of easy for us that, first of all, is it EdTech? Yes or no? It's a really obvious one, but we see so many deals that we would love to do, but they're just outside of our wheelhouse, so the obvious answer is no. But then it gets a little bit more nuanced. So if we're presented with an EdTech opportunity, if the business is outside one of the areas that we love, we won't invest. And to give you an example, and I touched on it yesterday, we try not to invest in businesses that target higher education. It's notoriously difficult to scale a business that's selling into universities. They're very, very slow to move. There's just so much not to like about it. So the next filter we apply is, do we really want to invest in this particular segment? K-12, also really tough. Corporate training, great. So we're on the lookout for different segments within EdTech. So we've got our second filter, and then we're looking for the metrics and the team that jump out. So if we've got a business with in our wheelhouse for revenue, if they've got gross margins of 75% plus, if they've got low capex. And likely at scale to have really high EBITDA margins, 20 million plus in revenue, then we're going to start to get excited and start to look into them.
Brilliant. Well, thank you so much, Peter. It has been such a delightful conversation with you today. And thank you so much for coming on and sharing your insights about EdTech and sector-specific investment. I know our audience members and people who are seeing us on CRISP definitely would have learned a lot. I know I have, for sure. And now to close off the event, I would like to invite our brilliant founder, Steve Torso, on the stage.
Thanks, Rhythm.
So just again, thank you so much for Peter to be involved. So I've got to know Peter over the last probably 8 months. And once again, I love it when people can give you actually insights on an area where you haven't thought too much about. And I know for us, EdTech, we've worked with a few companies in that area, but it's when you actually sit down and understand what the opportunity is and the different transformation in the space, and hearing it from someone like Peter, really, really appreciate it. So everyone, this concludes Emergence. So this is the final this concludes the presentation part of Emergence. Just want to say thank you very much for everyone that's come along. Thank you everyone for being networking. It's been a pleasure for us to see, literally inside the platform, we've been seeing thousands of messages go through as far as from people reaching out, connecting and messaging. And when we were thinking about the structure of this event, everything we thought about was how can we have obviously an engaging in-person experience, which everyone seems to do very well, but also how can we take that to the online experience as well? And that's always one of the hard parts as a conference organizer. And the other part then is what we want to do is then facilitate all the interactions which come after this as well. So for the next week, we will be leaving the software open. Right up, basically, we will then change it obviously to our UK event, which will be taking place next Friday. What we want to do with that is we also want to encourage you to basically connect with some of the UK investors and UK connectors as well that we've brought into the ecosystem, because once again, everything we do is about trying to bring ecosystems together, and that stands a key role in everything we've thought about. Some key things coming up for us going forward. At the end of next month, we're going to be looking to host the Venture Business Summit, which will be focused on founders and really be focused on the whole key thematic around that will be sustainable growth. And obviously the reasons for that is we all got driven into, in 2021, we got driven into hyper growth and spending. And then now obviously all of us as founders and obviously investors with their investee companies have been focused on sustainable growth for companies going forward. So, that's going to be the thematic for that event. And then also we're going to have some opportunities for additional engagement with us as a company and sort of collaborating. You probably would have seen we're obviously proud of what we've done from obviously everyone knows this from the event side, but we're obviously very proud of where we've got to from a software standpoint. And you must understand, for us, everything we are thinking about goes back to three key aspects. One is our vision, which is creating opportunities for tomorrow. I love that as soon as we leave this, basically we go into a whole bunch of networking, and literally the interactions, the engagement that takes place as part of that networking is really what makes these types of events quite special. And then also the next part for that is, from a mission standpoint, is empowering innovation, capital, and ambition. And if you notice, that is absolutely at the core of everything that's taken place over the last 2 days, but also everything we've thought about from a software perspective. So thank you very much for your support of the event. Next time, bring other investors along with you. I'm not going to hold you up anymore from more networking and drinking. Enjoy the rest of the session, and thank you very much for participating in Emergence. Have a good afternoon.
Oh, yes.